Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Don't blink. You cannot look away from the Bloomberg terminal right now. Another headline. Overnight, big tariffs on China. The response? China raises tariffs on U.S. goods to 84%. The reaction? Equities down across the board, -1% again on the S&P. In the bond market, no comfort there. Bond yields up by 8 basis points on 10s. In the commodity market, speaking to a deceleration in economic growth. Crude down across the board by more than 5%. It's a break of 60 on Brent crude, 59.33. Under surveillance this morning, nerves building on Capitol Hill.
In this scenario, the decision maker who decided the alla prima approach, who has obviously had to have spent time anticipating what we saw in the markets and some of the pushback, I'm assuming this all got gamed out because it's a novel approach, it needed to be thought out. Whose throat do I get to choke if this proves to be wrong?
Here's the latest this morning. President Trump's tariff rollout raising concerns for Republican lawmakers on Capitol Hill. Senator Ted Cruz also warning there could be a bloodbath in the midterms if tariffs push the economy into a recession. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back. Is the pressure starting to build?
Yeah. Hey, John. It certainly does appear that some Republicans are starting to sound the alarm that these tariffs are a little bit more than they bargained for, although we are still seeing them kind of walk the line between criticizing the tariff policy itself versus the tariff rollout plan. And we should just note, for quick context, as you well know, many of these congressional Republicans won the majorities in Congress by campaigning on that economic messaging. And some Republicans in some tight re-election races in 2026, like Senator Tillis, might feel like they don't have the benefit of an extra couple of years to see some of the potential policy benefits from these tariff plans. And as you mentioned earlier this hour, it's not necessarily new concerns from Republicans, particularly when it comes to potential impacts to farmers. And I went back and I checked my notes this morning because I had caught up with Senator Todd Young, a Republican from Indiana, after he questioned Treasury Secretary Scott Bessent during his confirmation hearing about how this White House would protect farmers. And at the time, he told me that he had assurances from this administration that tariffs would be targeted, except in some cases where they would be used as a negotiating tool. It is so clear, John, that we have blown past those expectations, not just of the market, but of these lawmakers who came out and had supported the tariff plans to begin with.
Tyler, today the big focus is going to be on China, I imagine, when Jamieson Greer sits down on the House side at 10 a.m. Yesterday, Trump claimed that China wants to make a deal, and he's waiting for Beijing's call. Any inference you're getting from the White House that she plans to call Donald Trump?
Well, at this point, Anne-Marie, we also have to note that there hasn't been a call between these leaders since President Trump was inaugurated. And we went from President Trump a couple of weeks ago saying that there could potentially be an in-person meeting between the two leaders. We saw Senator Steve Daines, another Republican who was questioning the USTR yesterday, travel to Beijing in a bid to try to make that potential meeting happen. And now we're, of course, at this broader escalation. And, of course, this goes back to our conversation about how farmers could potentially be targeted here. Of course, as you'll recall, the U.S. ag industry lost about $26 billion between 2018 and 2019 during the first trade war with China. But then I'd also point our attention to some of these other targeted actions that Beijing is taking, including when it comes to targeting increasing export controls on critical minerals. That's going to be another pressure point for this White House, as well as the future of the TikTok deal. There's a lot of different facets to this conversation.
Hey, Tyler, great work as always. Tyler Kendall there. Out of the nation's capital, with us around the table, Chris Harvey of Wells Fargo still. Chris, this is where we really started the conversation. Where does the circuit breaker come from? Could it come from Capitol Hill?
It has to come from Capitol Hill. You have to hear the administration acknowledge what's going on, and you have to have them acknowledge and communicate that they see it, they understand it, and you have to have them start to slow things down. This conversation about a 30-day pause, a 60-day pause, a 90-day pause, something has to happen. You cannot continually walk in and have more tariffs and more stress in the system, because the more you do that, the faster we go to a recession, the faster job losses come, and the faster this gets out of control.
But right now it's just rhetoric. Do you actually see Congress pulling back the reins and trying to take control, giving less authority to the executive branch when it comes to trade policy?
Yeah, Anne-Marie, I think if it continues, you go down that route, but that's a much slower route, right? And the market's going to move much quicker. And this is a question of confidence. Do the markets, do business folks have confidence in the plan, and what's the spill out from the plan? And right now, the markets are saying we're losing confidence, and we're losing confidence quickly.
So when it comes to circuit breaker, you think it's actually Republicans in Congress that could be the ones that put a stop to this? You don't see maybe it Xi Jinping or Donald Trump himself blinking?
I don't see, in the conversation, so a couple things there, because that's a big question, right? The situation between China and U.S. appears to think that China is the existential threat. We can have that continue, and likely that does continue. But if we get positive news from the EU, from Japan, from other places where there is actually progress, then things can improve. China is toward the end of my concern at this point in time. Can we get our allies to come on board? Can we strike deals? Can we move forward? Can we make progress? If we're showing progress, the markets will react positively. If we do not show progress, the markets are not going to react positively.
There's a story in the Financial Times about how U.S. ports are getting really crowded, that a lot of companies are delaying their car shipments,
Right.
and they're just holding them at the ports, hoping that maybe in a couple days, these tariffs will be removed. Maybe it'll take 4 days, maybe it'll take 5 days, and they're about to reach capacity at these ports. What will it take for both companies and for the markets to realize this is real?
Listen, it's real, right? So the complexity of this, you cannot turn around in a couple days, in a couple weeks, because you've basically tariffed or taxed almost every single country out there. In order to unwind that, it's no small feat. The other thing is, governments do not move quickly, right? And because of what we've done, people want to protect themselves. So they're going to have to talk to their lawyers, to their leaders, to their parliaments or whoever before they take some action. We can have the conversation, but the actual action and execution is going to take, I think, a long period of time.
What are we seeing in markets? Is this just the fear that this is going to have a suppression to growth, or are we getting actually a sense of what markets are repricing as the new normal?
Yeah, the markets don't really know the end goal, right? Is it negotiation? Is it revenue generation? Or is it something much bigger, right? Do we want to change the way we do trade throughout the world and for the rest of time? That's a big question. So the markets are just trying to figure out what's going on, and the markets are trying to send a message. We need better communication. We need to understand the goal. When we get to the goal, what are you going to do, and how are we going to do it?
To start that process, to engineer that supply-side response, you've got to believe that these are the rules of the game. And we're still sat here saying, is this a negotiation, or are these the rules of the game?
I love how Chris puts it. The market is crying to the White House. We want better communication. Can we have a therapist come in here and try to clarify what the end goal is? Are we meant to be together? Are we meant to be apart?
Is this therapy again?
Well, it sounds like a lot of people are trying to get into the psychology of the moment.
What do people say? Cry harder. That's what we're doing right now.
I think that's what we're doing on every single market.
Got to find some light humor in a moment like this one. We're down again by 1.4% on the S&P. A special thanks to Chris Harvey of Wells Fargo. If you're just tuning in, welcome to the program. Moments ago, about 25 minutes ago, we got China's response to the overnight tariffs from the US side. 84% on US goods. That's driving equities lower, not just stateside, but in Europe too. And in the bond market, bond yields are higher, not lower, again this morning. I know that got the attention of many of you yesterday. It's where we're focused again this morning. Why aren't we seeing that haven bid into treasuries? Yields higher by 8 basis points, the 10-year 437.42. Earlier on this morning, Delta Airlines coming out and pulling guidance. Up next, we'll catch up with Sheila Kahiyolu of Jefferies from New York City. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Live from New York City, welcome back. Equity futures sliding here by 1.2% on the S&P 500. On the Nasdaq, lower as well by 0.9% on the Russell. We're down by 1.8%. 30 minutes ago, we learned China's response to America's tariffs. China raising the tariffs on U.S. goods to 84%. With 2 hours until the cash open, let's get to your morning movers. We can do that this morning with Danny Berger. Hey, Danny.
Hey, John. Look, it's been a volatile morning for the benchmark, but one thing has been consistent, and that is the pain in pharmaceutical stocks this morning. Pfizer down nearly 4%. If it closes at the level it's currently at, it would be its weakest price since 2016. The sector under pressure after President Donald Trump last night saying that there would soon be an announcement on pharma tariffs. BMO writing that for the industry, they'll be unable to move their supply chains because they are so complicated. This shatters the illusion of safety that they would be spared. Some earnings to work through. Delta, we've been talking about this all morning. Here's one of the playbooks. You can just give no guidance. They withdrawing their guidance for the full year, citing the uncertainty, saying that they would provide more clarity once they get it. Also cutting their capex and their capacity, saying that we are controlling the one thing that is in our control, and that is margins. You can see Delta shares, though, barely holding on to the gains at this moment, up 1/3 to 0.4%. Here's another playbook for earnings, and it comes from Walmart. They have their earnings, full earnings, on May 15th, but ahead of that saying that we are keeping our first quarter outlook unchanged. That's a gain of 3 to 4% in sales. Our fiscal year 2026, that's also staying the same, of course. The irony, though, is even though they've kept their guidance the same, shares are falling 1.6%. But John, unfortunately for them, they pre-announced that just at the same time as those China tariff headlines crossed.
Hey, Danny, appreciate it. They might have some work to do on that outlook, that's for sure. Danny, appreciate it. Equity futures on the S&P then sliding on our radar this morning. President Trump's historic tariffs on China taking effect. The latest round of levies pushing as high as 104%. Trump also slapping 20% tariffs on the EU. China's responding with levies of 84% on U.S. goods. The countermeasures going into effect tomorrow. China also adding 6 firms to its unreliable list and 12 entities to its export control list.
So this is now the full tit for tat. You see this escalation and this rift. What I would say is, what is the off-ramp? Who blinks first? Trump claimed yesterday China also wants to make a deal. He said they want to make a deal badly, but yet Xi Jinping has not called. Caroline Levitt then was asked about this, and she said, we will be gracious if China's leadership reaches out. Well, guess what? They're reaching out with an 84% tariff.
How do companies respond to this? Let's say these do stick. Do they just expect that they'll eventually be taken off? Do they make investments to try to shift the supply chain? And then to where? Is it back to the United States? I think Walmart's guidance was interesting because they did say that they have a wider range of outcomes for its first quarter operating income growth. And get this, for some sort of nice euphemism, they may have to, quote, invest in price, which will, quote, widen the range of outcomes for its first quarter operating income growth. In other words, they might have to eat it. And that might eat into their profit margins, and that might be what you see from them.
Thanks for attempting to translate the McKinsey, because I think we're going to see a lot of that in the coming weeks, aren't we?
I mean, how do you say something that is uncertain and that potentially is highly unsavory? Markets are able to also translate McKinsey, which is maybe why the shares are a bit lower.
This is going to be highly industry specific, and we've all said around this table repeatedly, you need to be very open-minded about the kind of consequences that we could see. Clearly for the airline business, you cut capacity because you think things are going to be not as busy as you thought they might be for the year ahead. For other companies that might have to increase capacity to meet domestic demand, they're not going to do that until they're 100% sure that these are the rules of the game. And the administration has spent the past few days saying you can negotiate. So in the meantime, what are those companies, what are those industries going to do?
Especially if you're worried about pricing power and you're worried about a consumer that is exhausted and not able to take on that much more. Well, that means that they can't really expand their profit margins to offset any potential increase in the costs that they are seeing. So what do they want to do? They want to sit tight. They want to have less inventory. They want to necessarily have less overhang and potential exposure.
We've mentioned Delta a few times this morning. If you are just joining us, these were the numbers. So basically what they've done is withdrawn their full year guidance, citing uncertainty around global trade. The CEO, Ed Bastian, saying, quote, "It's very difficult to predict what policies may look like over the course of the year, that's for sure." The stock is up by 1.7% as Bastian adds that revenue has flatlined. Joining us now to discuss is Sheila Kahyaoglu of Jefferies. Sheila, welcome to the program. If Mr. Bastian can't offer any guidance, can you?
I don't think we can either. We cut our estimates earlier last week across the entire airline landscape, assuming flat domestic pricing for the year. What we're getting from Delta is suspended guidance, clearly, and that's probably the best strategic move from here. But it assumes something worse than that for Q2 in terms of flat domestic pricing, and then a second half capacity is flat. So not great news out of the U.S.'s largest carrier in terms of what they're saying.
Sheila, you've talked about this repeatedly. The high income bracket here in the United States holding up business for many of these airlines, premium, long haul. Sheila, are you seeing building evidence that maybe we're seeing something we haven't seen over the last 5 years, that they're starting to take the hit here?
I think premium and Atlantic or international are actually still holding up. But we just got off the phone with Dan Junke, Delta CFO. It seems like the bookings visibility there is decent. What you're seeing the contraction is in the main cabin, which is where we would see it. But also notably corporate. Corporate really saw a move down in February and March. Industries that were particularly hit were industrials, aerospace, of course, and some other sectors, while financials and tech held in there, it seems. So corporate is also taking a leg down. So corporates are clamping up a little bit, whether it's the tightness in just, cost cutting, or if it's the macro volatility that's causing that is to be determined. So that's where we're seeing the premium hit is really within the corporate customer trending down.
We are seeing some commentary from Ed Bastian, the CEO of Delta. This in the Wall Street Journal. He said he understands there's a role to play with tariffs and trade policy. It's just hard when you're trying to do them all at the same time. He also said, "I don't think we're in a recession. I think we're in danger of talking ourselves into a recession." When you talk to executives, particularly from airlines, is there a level of frustration that the consumer does seem strong, willing to accept even price increases, still looking for experiences, at the same time that there's a lot of gloom and doom on Wall Street and a potential regime shift that could just torpedo that?
It's interesting because Delta's telling us they saw it within the consumer trend down really quickly, whether it was in February and March in the first 5 to 7 days of April. I'm actually in Atlanta right now. I'm at a trade show, an aerospace aftermarket trade show. And the 10 executives we met with yesterday were so confident regarding tariffs. They don't think it'll have as much demand destruction as people assume. And that pricing will actually be positive because they could pass it through to the end user, which is, of course, the airline, which is, of course, the consumer in the U.S. So I think we're seeing that short cycle hit with Delta this morning, a massive change with what they previously guided. They had guided a capacity up 4, now it's flat, and pricing also taking a swing down 2.5 to down 6.5 in their forward outlook for Q2. So we're seeing that major revenue cut, not only from a capacity perspective, but from a price perspective, and the airline's doing its best to stay profitable, show that it's it's positioned well for this with its relatively low leverage, but they're only growing their net fleet less than 1%. So taking into account Boeing Airbus deliveries and their retirements, that's less than 1%. So they're clamping down on their costs as well.
This is a really fascinating dichotomy right now, Sheila, because on one hand, you have the airlines saying, ostensibly, they believe they have pricing power. They believe that they can raise prices and that you could shrink potentially just your flight schedule and keep prices where they are, go higher and offset any kind of change. You're hearing something so different from the likes of Walmart that want to invest in price, i.e. absorb some of the increase in prices. Is there some sort of structural change that gives airlines a strategic advantage to being able to have pricing power?
So the airlines are clearly saying pricing is stalling. Pricing and capacity are stalling. The aerospace show I'm at is more the manufacturers and the maintenance providers to the airlines. They're still seeing that they have the ability to pass price through. One is a shorter cycle buy. With an airline, a consumer booking is maybe 30 to 90 days, and that's where we're seeing the hit with Delta. The aerospace show I'm at is probably 30 to 1 year buy cycle. So the shorter cycle is definitely seeing the market volatility impact its demand and its pricing.
Sheila, Delta is a Virgin Atlantic partner on its North Atlantic routes. We saw Virgin Atlantic pull back some of those routes, especially when it comes to New York City, this major hub, JFK. Are you expecting more airlines to pull back some routes?
I think international is the region we're going to watch the most. So to put it in perspective, in terms of domestic is very important. Delta had previously $7.35 of EPS. Every 1 point of domestic pricing is about 85 cents to EPS. Internationally, every 1 point of pricing is maybe 20 cents. Internationally is still holding up, but what we're seeing there in the second half and into in Q2 and the second half is actually a decent amount of capacity, whether it's Delta, whether it's United, whether it's American. Capacity is up mid-single digits, up 4%. So if you have a lot of capacity, not a lot of demand, what happens? Your price gets cut. So Atlantic is still holding up strong in Q2. They're fairly well booked into April. I think 90% booked in April, 60% booked in May, and 40% in June, and that's system-wide, so internationally would be better than that. So right now, international is still holding up, but again, that's a longer sales cycle, probably 90 days instead of 30 days for the domestic side.
Sheila, appreciate your time. Thanks for jumping on. Busy morning for you, I'm sure. Sheila Kohli there of Jefferies. The latest on Delta as they pull their guidance. That stock is positive for now in the pre-market by around about 1%. The big headline this hour, though, escalation. It comes from China. China turning around and putting 84% tariffs on U.S. goods in response to major tariffs from the United States overnight. Equity futures this morning, near session lows, down by 2% on the S&P, negative 1.8% on the NASDAQ. In the bond market, this move continues. Bond yields higher across the curve, up by 12 basis points on 10s, on 30s up by 12 to 488. The headline that we're getting from the Treasury Secretary in the last few moments, speaking to the American media a little bit earlier this hour, saying this on the tariffs. This escalation is a loser for them. Turning around, the Treasury Secretary saying it's unfortunate. The first response from the administration following those tariffs this morning.
Where's the off-ramp? Are we seeing it in these comments? Not necessarily. From President Trump, is he really going to back down when he's talked about going in harder? This really is becoming a tit-for-tat of retaliation, and the ripple effects not only for some of the exports from China to the United States, but also U.S. companies that rely on Chinese sales. How significant will that be?
What Scott Bessent told to me, the Treasury Secretary, after Liberation Day was that this is a cap. Do not retaliate, and potentially we could bring your tariff rate lower. We heard that again from Jamieson Greer yesterday, speaking into the Senate. So I'm not surprised that Treasury Secretary Scott Bessent is coming out today and saying this is unfortunate, because what they wanted to see was cool heads to prevail, so they would have these windows of opportunities to strike deals.
We said to the Commerce Secretary only a few weeks ago, just last week, come on the program, and we turned around to him and asked, are you underestimating or misestimating the amount of leverage that you have over China? Because they're not coming to the table. they're not coming to the table. In fact, they're retaliating. Now, I think overnight we saw some comments and people thought that maybe they were ready for talks. But based on that headline, that's not what this president's been asking for at all.
No, they're retaliating, and they're not just retaliating with tariffs. They're also putting more American companies on the entity list. They're going after export controls. You know what else they're doing? They are having outreach with European leaders. Ursula von der Leyen yesterday, the Spanish Prime Minister today. Xi Jinping will be making a trip to Cambodia and Vietnam later this week. They are trying to shore up regional allies and the Europeans to say, look, if the walls go up and you can no longer do deals with the United States, we will be your safe haven. We will be a place that you can still do business with and trade.
Speaking of safe havens, can we pull up the bond board again? 2-year, 10-year, 30-year. Bonds are not acting as a haven right now. Lisa has talked about this repeatedly so far this morning. Speaking of the Treasury Secretary, later on this afternoon, he is going to be very focused, Lisa, on what you're focused on every single week. The supply coming from the Treasury, $39 billion of 10-year notes.
This has the potential to be quite messy. A lot of people have been talking about that. A lot of banks are trying to pull back on risk. So if they are forced to bid on these auctions, they are going to be shorting treasuries elsewhere to offset that potential exposure. There isn't the absorption capacity that a lot of people were expecting. So yes, it could be basis trades unwinding. Yes, it could be foreign selling. Yes, it could be just simply a lack of buying. But you add $39 billion of supply to this, it becomes a real potential note of concern.
We add another 12 basis points to a 10-year Treasury yield. We're through 440 this morning at 441 on 30s, getting closer and closer to 490 at 488. A lot to get through. A lot to get through this morning. Let's get to it. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Ankara is withdrawing its director nominations for U.S. Steel's 2025 annual meeting. The firm citing reports that Nippon could be gaining support from the Trump administration for its takeover bid of U.S. Steel for $55 per share. Monday, Ankara unveiled a plan to jumpstart U.S. Steel and nearly double the stock price to $75 per share. A former Meta executive plans to testify before Congress that the company briefed the Chinese Communist Party on emerging technologies, including AI. The corporate whistleblower alleges that Meta aimed to help China outcompete American companies. Meta, for its part, denies the claims. Elsewhere, demand for used gold Rolex watches is on the rise. Gold prices have, in turn, risen more than 10% this year. The Bloomberg Subdial Watch Index, which tracks prices for the 50 most traded models, has 3 gold Rolex timepieces climbing the most places up since the index was launched in 2022. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on in the hour. Up next on the program, betting on the Fed put.
If it's foreign selling, we could go towards 450. I do believe the Fed would step in because the plumbing of the system is no longer working at that level, and they will step in to stabilize the plumbing and have proper market functioning.
Up next on the program, we'll catch up with Tony Rodriguez of Nuveen from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
In case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but Also, this is a nascent industry, and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Waking up with a cup of escalation this morning from China, raising tariffs on US goods to 84%. The bond market offering no comfort at all. Yields are higher across the curve, up by 8 at the front end, on a 10-year up by almost 13, on 30s up by 11, 488. Under surveillance this morning, betting on the Fed put.
Heading into Liberation Day, we thought that last week would be the week of peak uncertainty. It was not. I'm not a believer that the price or yield that you see is a reflection of market expectations. It's a reflection of that marginal buyer or seller. If it's foreign selling, we could go towards 450 if it is. I do believe the Fed would step in because the plumbing of the system is no longer working at that level, and they will step in to stabilize the plumbing and have proper market functioning. It is one of their roles. So for that reason, we believe in 10s, US 10s at 420 to 450 is a buying level.
Here's the latest this morning. The Fed isn't racing to step in, and the bond market is offering very little comfort. Tony Rodriguez of Nuveen writing, we forecast the 10-year yield at 4% for year-end, that we expect volatility to remain elevated and for the trading band to remain wide in the near term. Tony joins us now for more. Tony, good morning.
Good morning. Good to be
Let's get straight to that bond board. It's good to see you. Yields are up across the curve. Why are they up across the curve by double-digit basis points on 10s, on 30s?
Well, there's a lot of reasons that people are providing. In our view, there's a couple of main ones. Inflation, number one. Inflation is going to be significantly higher than we had expected prior to these latest rounds of tariff increases. And obviously, that's very negative. Number two, the inflation hit is up front. The growth drag is a little more delayed. So we don't expect to see any kind of rally in rates until we start actually seeing the hard data begin to reflect the slowdown. You also have, in our minds, foreigners that are backing away from the market, less confidence in the dollar, less confidence in U.S. policy, so you get that. And the third thing is the leverage unwind. With these kinds of moves and this kind of volatility, everyone is lowering their leverage. A lot of basis trades people talk about, et cetera. You're seeing that. So I think there's a bunch of factors, but they're all pointing in the same direction, and there's no offset like you would say, well, maybe the Fed will step in. There's nothing for the Fed to step in for yet.
We'll get to the Fed in a second. Earlier this year, there was the Bessent put. Everybody said, don't bet against the Treasury Secretary, who was saying that he was targeting 10-year yields and wanted to see them lower. Is the Bessent put dead?
Yeah, I don't know if the Bessent put ever really existed because I don't know what policies they had set up in order to drive those yields lower. This Bessent put is related to an economic collapse from tariffs that are, 50%, 100%, et cetera. So you might get what you want, but you get it for the wrong reason. So we don't think the Bessent put is there. Right now, the tariff policy is really the main driver because that's what's impacting inflation and that's what's impacting the medium-term growth hit, which is why you're seeing all the selling in equity markets, for example.
Not to get too existential, but what is your confidence level that in the case of a real real growth slowdown or even a contraction, the treasuries would be the haven bet, that you would get a massive bid in, that yields would go substantially lower, because if the U.S. wanted to give some fiscal support to this economy to get it out of some sort of recession, its hands are a bit more tied than it has been in the past.
Absolutely. So the ability to respond to that slowdown is very challenging, which is why we think growth, while we're not yet forecasting recession, we're forecasting 0.5% growth if we stay with tariffs that are around this level, or even move back to tariffs that are, let's call it, around half of current levels. If we stay at these levels for the balance of the year, then we tip into a recession call as well. And in that environment, because it's driven by U.S. policy, kind of that self-inflicted wound, then it is possible that treasuries won't provide that haven. You won't see as much of a rally. You'll still see, we think, yields decline, but they won't decline to levels that would be typical in a more market-driven, economic shock rather than a policy-driven, self-inflicted wound.
Tony, let's just recap these headlines from Secretary Bessent again. He's speaking a little bit earlier this morning, and this is what he said. What he sees in the bond market, normal deleveraging in the bond market, nothing systemic. There's a word that was thrown around going into the weekend. I threw it around too, orderly. What's the difference between orderly and disorderly, and how close are we to the latter and not the former, given the moves we've seen in the past few days?
Yeah, I'd say we're still on the orderly side, and the main difference in our minds between the two is when you have a financial accident. You have a leveraged fund that basically goes under. You have, for example, if you look at cross-currency swap spreads, they blow out. You look at short-term funding markets, they implode and, for example, seize up. We're not seeing that yet. We're seeing all of the initial steps in that direction. So certainly the markets are challenged. They're not quite crossing over the line into disorderly yet, but with every day that we see continued volatility, continued escalation in tariffs, I think we get a lot closer to going across that line. That's when the Fed might begin to be able to step in.
Not to put words in anyone's mouth then, isn't the Treasury Secretary basically telling the Federal Reserve there's nothing to see here?
Yes.
There's nothing disorderly to step in and fix. That's the message from the Treasury Secretary this morning based on these comments. Nothing systemic, normal deleveraging in the bond market. So if he's saying there's not a problem, why would the Fed step in? For market functioning reasons.
And what exactly could they do? If they cut rates on the short end, would that actually help or hurt the long end? Deutsche Bank's George Saravellos came out this morning and said if recent disruption in the U.S. Treasury market continues, we see no other option but for the Fed to step in with emergency purchases of U.S. Treasuries. Talk about kind of what the Bank of England did back with Liz Truss back in 2022.
Certainly got echoes of that. Tony, just a final thought. What do you do from here? What's your approach to this market?
Yeah, so tremendous uncertainty, so you need to be more conservatively positioned than you were. You need to have more cash, right? So liquidity is paramount in this kind of environment to be able to take advantage eventually of a dislocation. And you need to be following the metrics that will indicate whether there's any kind of backing off. We don't see that right now from any foreigner. Like China's not going to step up to the table in our minds. They're watching what's occurring, and really that's applying very little pressure. The more they wait, maybe the uglier things get, and all of a sudden the leverage shifts a bit. So we don't think, we think we're going to be in this period for quite some time.
Tony, it's good to see you. Thanks for breaking things down for us. Tony Rodriguez there of Nuveen. Breaking down this bond market. This bond market's breaking down. Yields are higher by 14 basis points. The 10-year 4.43. Twos are up by 7. At the front end of the curve, 3.80. And the equity market's rolling over as well. Equity futures on the S&P negative by 1.9%. The third hour of Bloomberg Surveillance is just around the corner. Your lineup looks like this. We'll catch up with Richard Bernstein of Richard Bernstein Advisors. We'll speak to Ryan Peterson of Flexport, Sarah Wolf of Morgan Stanley, and Rusha Sharma of Rockefeller International from New York City. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China show live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Most market participants are not expecting tariffs to last longer than a couple of months.
There are some longer-term positives if we can potentially negotiate some with these tariffs.
The one clear conclusion from Paris is that they are U.S. growth negative.
All these things really aren't sustainable in the long term.
If the full expected tariffs come through, that would likely trigger a recession.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, 90 minutes away from the opening bell, and we've got some escalation to talk about. Major tariffs go on overnight on the rest of the world from the United States of America. Equity futures gapping lower going into that opening bell as China responds. China retaliates. Here's your escalation. 84% tariffs on U.S. goods. Equities down across the board. On the NASDAQ, we're lower by 1.6. On the Russell, we're down by 2.6. In the bond market, no comfort provided whatsoever. Yields are higher across the curve, up by 8 basis points on 2s, up by 16 on 10s, 445 on 30s, approaching 5%, 491 this morning. And later on this afternoon, we've got some bond supply for you, 1 p.m. Eastern time. This is the number for the 10-year auction, almost $40 billion of 10-year debt coming to market. The Treasury Secretary, Scott Bessent, speaking this morning, saying it's normal deleveraging in the bond market, nothing systemic.
Well, there is something systemically that is a bit awry or making people deeply uncomfortable. It's that bond markets are not providing a haven right now. They have not been the market of choice, even as you see German 10-year yields go lower, as well as French 10-year yields, and you pick your domestic market of choice. You're also also seeing gold that now is rebounding, but the dollar also weakening. So all of these haven trades are no longer functioning at a time when so many people are wondering, what is the new world order going to look like?
Well, this is what the president would like it to look like. He spoke a little bit early this morning, posted on social media. This is a great time to move your company into the United States. Don't wait, do it now.
But companies are waiting on the sidelines. It's paralysis. They want certainty. What have we heard from every single guest today? We're at almost peak uncertainty. We don't know what the next steps are. We are still sitting around the table today and questioning, is this a negotiation? And the Treasury Secretary earlier this morning saying that actually it's exciting because you have places like Vietnam coming today for negotiations. They're excited to start negotiations with Japan. At the same time, we are in a serious escalation when it comes to Beijing.
To engineer that supply-side response that you're talking about, to engineer that supply-side response, you need to believe these are the new rules of the game. And as long as you go around talking about negotiating, companies will just sit there and do nothing. They're not going to build that factory until they know for sure those tariffs aren't going away.
There is a maturity mismatch, as that one viewer yesterday wrote into you, in terms of the near-term impact of tariffs versus the long-term response of possibly building out factories. Look, right now, as the president tries to negotiate, it seems like the market is giving it less leverage to move, given the fact that the market is saying that companies are going to suffer. You're seeing Walmart coming out and saying they're going to invest in price, i.e. have smaller margins as they try to maneuver through this. And you have Delta saying that they are going to cut capital expenditures as they batten down the hatches to deal with this uncertainty.
It's another morning facing the same question. We've said this on this program repeatedly. Are these the rules of the game, or can you negotiate? And a pendulum keeps swinging between the two. Every single day, hopes for a deal, fears about tariffs, a headline about equities up or down. Anne-Marie, the underlying trend, and you've been talking about this for weeks now, if not months, the underlying trend is that tariffs are going up. They're higher than they were a week ago, 2 weeks ago, and they keep climbing higher.
And even if there are deals, most people think that no one's going to get a deal below 10%, that baseline they set for every single country on that list, on that board the president came out. So regardless, there will be higher tariffs. But can you have potentially a deal where there's something towards reciprocity? I still think there's potential for that for most countries besides one, and of course that's China.
So seen, equity futures down by 1.8% on the S&P, bond yields higher by 16 basis points. The 10-year, 445. Coming up this hour, we'll catch up with Richard Bernstein of Richard Bernstein Advisors as trade tensions shake up markets worldwide. Ryan Peterson of Flexport as shippers brace for the impact of Trump's tariffs. And we'll speak to Rashesh Sharma of Rockefeller International on why the Fed shouldn't try to save the world. We begin this hour with stocks lower. After 4 days of losses on the S&P 500, Richard Bernstein of Bernstein Advisors writing, the Fed is caught between a rock and a hard place. GDP forecasts are being revised downward, but inflation expectations seem poised to accelerate. Richard joins us now for more. Richard, welcome to the program. You put it in your note. Everyone's got a plan until they get punched in the face. That famous strategist on Wall Street, Mike Tyson. How strong is that punch this morning?
I think the punch is a real. It's not a jab. It's a real roundhouse punch, and I think. John, look, you've been talking a lot about all the different uncertainties and all the different things that are going on. That's fine, but I think one also has to realize that we entered the year with investors historically confident. So this has a magnified effect on investors' confidence that they're being shaken. So that was my point about that everybody has a plan until they get punched in the mouth. Because everybody had a plan. They thought it was easy. They thought this was like, oh, you know, let's just buy an index fund or let's buy the Mag 7. And all of a sudden they're realizing that was the unusual period. And now we're going back to something that's much more uncertain. And they're getting punched in the mouth.
Richard, Scott Bessent, Treasury Secretary, speaking with Anne-Marie, our own here, and saying that this then is not necessarily a MAGA problem, it's a Mag 7 problem. Do you agree? Is that basically what you're seeing right now is the unwind of an overvaluation of a crowded trade at the end of the last year, beginning of this one?
Well, Lisa, I understand where he's going with that question, but my response would be, why is the Russell 2000 underperforming so dramatically here? If it were just a Mag 7 point, why are the most domestically focused companies in America, smaller companies, are underperforming, right? So how is this just a large cap MAGA effect? It's clearly not, or Mag 7 effect, sorry. It's clearly not. I think this is a comment. The markets are making a comment on the broad economy in the United States, and I think also the notion that this is an orderly process. That's fine. I would agree with that, but the process is not a positive one. The markets are not giving a positive verdict on that, and that's kind of what I think people are still sort of missing here.
Richard, how do you navigate a situation like this where the rules of the road may be called into question over a longer period of time, and asset allocation potentially could look very different if the trends that we're seeing in markets today would hold? So how are you thinking about not just short-term investing, but the 1 year, 2 year, 5 years ahead?
Right. So Lisa, I think in the short term, you're using the word uncertainty. Everybody's using the word uncertainty. I shouldn't personalize it like that. Everybody's using the word uncertainty. So what that means is the scarcity in the marketplace is certainty. That's what will command a premium through time, is certainty. What does that mean? That means quality. That means more certain cash flows. It means dividends. It means really kind of focusing on near-term fundamentals as opposed to long-term growth stories. The second thing is, what do you do for 3 years, 5 years, 10 years, 2 years, whatever? And I think, look, the goal of what's going on, of returning industrial processing back to the United States and manufacturing back to the United States, I think that's a great goal. In fact, we've been talking about it at my firm at Richard Bernstein Advisors for 10 years. I wrote an op-ed in 2011 in the Financial Times about this topic and how important it was. The goal is real. However, the method that they're choosing to try and get to that goal, personal opinion here for a second, is incredibly ham-handed. There are many better ways to do it that do not place a tax on the U.S. consumer.
Richard, we heard from one ECB official earlier on this morning that said there's no reason for a rate cut right now. I think he referred to 50 basis point cuts as ridiculous. Mary Daly, the San Francisco Fed president, putting out a post on LinkedIn saying we have the time and space to deliberate our next moves. Lisa, that's what's different about this moment. These officials at these central banks aren't rushing to race in, rushing to step in and provide support like maybe they would have done a number of years ago.
And for the correct reasons, which is this is a very different type of crisis that is not of the credit markets making. This is about policy uncertainty and the potential stagflationary shock that comes along with inflation. If you take a look at 2-year break-even rates, they've actually hit the highest level going back to 2002 earlier this morning. It's shifting around, incredibly volatile markets, but the signal is not so clear in terms of how they should act, let alone if.
Richard, are you thinking about where pockets of leverage might be? This has been a really unusual cycle here in the United States and worldwide because of the support that was offered through the pandemic and through the recovery as well. When you think about where pockets of leverage might be this time around, how do you answer that question?
So John, it's related to what you and Lisa were just talking about. The Fed was spoiled for many, many years, two, 3 decades, by globalization. Globalization was a massive disinflationary force on the U.S. economy. Why? Because we were just increasing competition. And we all know when you increase competition, you put downward pressure on prices. So the Fed could play the hero and ride in on the white horse and save the day. Now what we're seeing is deglobalization. That whole disinflationary process is now being reversed, so it's now an inflationary process. That ties the Fed's hands. And the Fed can't play the hero anymore. And I think that's one of the things that's happening. So where is the pocket of leverage? I don't really know. One could argue that it's in the private market somewhere, because I think that a lot of their returns have been boosted by leverage and the ability to borrow cheaply to make acquisitions. There's where it is. It's certainly not going to be. I would argue it's unlikely to be in the big banks. The big banks, for all their whining about over-regulation, big bank balance sheets are pretty strong. It looks like the regulation has worked. But where is that leverage? It's in things like private debt and all of that. So the risk hasn't gone away. It's just moved, I think, from the public markets to the private markets. It's an interesting monetary and fiscal question, is that if there is some kind of problem in the private markets, they're supposed to be private, will they come to the rescue? I would think they'd be very hesitant to do that.
The Treasury Secretary this morning is saying really nothing to see here. I feel like I'm going to sound like Lisa, but how do you think this bond auction is going to go today for the 10-year?
Well, a little outside my area of expertise. I just don't think, I think what we are seeing is a complete repricing of U.S. assets with a higher risk premium, right? If you think about it, we've taken about 5, maybe 6 multiple points off the S&P despite good earnings. We're seeing in a very short period of time the 10-year sell-off, but certainly bond volatility has gone up, whether you agree with my statement about the risk premium or not. Certainly bond volatility has gone up. And I think what's happening is U.S. assets are being repriced. You know, you mentioned before about, you know, are we a safe haven anymore? Maybe not. And that's kind of what we're seeing.
I spy the Tottenham emblem right behind you as well, Richard. Super depressing stuff for you, eh? Appreciate the time, as always.
Rough season.
Thank you, sir. Richard Bernstein of Richard Bernstein Advisors. Thank you very much. Equities near session lows on the S&P 500. Difficult moment for this equity market. Just to breathe some life into that conversation on the central bank PERT. Who remembers that news conference in 2020? Christine Lagarde of the ECB. We are not here to close spreads. What does she do later on? Close spreads. Everyone's got a threshold. The difference this time around is that because of the nature of the shock and the potential economic consequences, that threshold might be a whole lot lower than we thought it was for this ECB and likewise for this Federal Reserve.
The other wrinkle in this is that they have to be responding to immediate circumstances. During the pandemic, the entire world just shut down and travel shut down. And suddenly there was this question about supply-demand dynamics that were totally skewed. Right now, companies are not raising the sort of huge 5-alarm siren that you would expect. That is not what we're hearing from Delta. That is not what we're hearing from Walmart. How does the central bank respond to that with data that's still holding in?
I remember when people thought the president would back away at 5,500 on the S&P. And here we are sat at the 5K at a close as of yesterday.
He didn't want to answer the question if there was a Trump put, if a threshold still existed. He actually said it was a stupid question, but then went on to say, sometimes you have to give medicine to fix something. This is self-imposed. This is policy medicine from what the president thinks should be fixed when it comes to global realignment. What's the cure to Trump's medicine is the question we're all asking this morning.
Super difficult question to answer. Equity futures at the moment on the S&P negative by 1.8% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Just to round up what we have in tariffs at this moment, President Trump's so-called reciprocal tariffs are in effect. That includes a 20% levy against the EU and a historic 104% tariff on China. That follows a 10% baseline tariff for most U.S. trading partners that took effect on Sunday. Now, in retaliation to those moves, China is raising tariffs on imported U.S. goods to 84%. A government statement released over an hour ago said that the countermeasures will come into effect on April 10th. China also said it would sue the U.S. at the WTO and added 6 firms to its unreliable entity list. Elsewhere, Delta Airlines has withdrawn its full-year financial guidance, citing uncertainty surrounding global trade. Shares up about 1/3%. The company said that it will update the outlook later in the year as visibility improves. It also trimmed CapEx and cut its plan for capacity growth to flat for the second half of the year. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Another update from Danny coming up in about 15 minutes' time. Up next on the program, we'll get you some morning calls. Plus, we'll catch up with Ryan Peterson of Flexport as shippers brace for the impact of Trump's tariffs and China's retaliation. From New York, this is Bloomberg.
Tech is influencing global markets.
Technology
technology is driving business across Europe.
Companies in Asia are betting on tech.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Live from New York City, your equity market looks like this. 1 hour and 13 minutes away from the opening bell. Equity futures down across the board. A wild few sessions to start the trading week, that's for sure. We're down by 1.8% on the S&P. On the Nasdaq, we're down by 1.5%. Retaliation from China, 84% tariffs on US goods. After the US slapped major tariffs on the rest of the world overnight, equities are down across the board. That's the price action. Let's get to your morning calls. First up, Jefferies upgrading Apple to hold, expecting a potential tariff exemption for the company, but noting downside risk. That stock is down by 2%. Everyone still thinks, who covers that company, that we'll get that exemption. Let's see if we will. Next up, Benchmark adding Tesla to its best ideas list, saying concerns over declining sales are overblown. The stock is down by 0.7%. And your third and final call comes from Bernstein, downgrading Ford to underperform, seeing significant downside for the stock due to tariffs. That stock is down by another 2.4%. Let's stick with those tariffs. Global shipping taking a major hit. Ryan Peterson at Flexport saying 28% of the customers at a company call last week said they're pausing all ocean freight bookings from Asia until there's more clarity on where tariffs will end up. For a clinic on shipping and a whole lot more, Ryan joins us now for more. Ryan, welcome to the program, sir. I want to start with a really important question because I think there's tons of confusion out there about this. Help me understand, if a ship is already at sea and it's declined, say, a port, has left a port in, say, Asia, and they arrive in a week's time, do they pay the tariff or not?
No, they would not pay these new reciprocal tariffs. The way that it works, I mean, typically throughout history, it's based on when the goods arrive. That's what the duty rate that you pay is. However, with these reciprocal tariffs, they made it so that as long as your ship departed by midnight last night, then you only pay 10%, a 10% additional tariff. It was midnight, April 5th was the deadline to pay no additional tariff. So if the goods have been out there on the water since then there's no tariff. So there was a mad scramble the last few days to get every container into the ports and loaded, and hopefully those ships departed. Hopefully your ship departed by midnight last night.
Yeah, Ryan, could you help us describe that?
That is midnight Eastern time, not local time in Asia.
Interesting. Can you just describe then how that mad rush came about and what that looked like over the last few days?
Yeah, I mean, a lot of containers actually switched to air freight to make sure that they got out on time. There was just this rush. Ocean freight, the goods have to arrive at the port several days before the ship departs. Air freight, you can tend to get to the airport in a matter of hours before the plane leaves. So there was a switch over to air. I read somewhere that Apple chartered 5 747s for iPhones. So yeah, like a big scramble to get things. Flexport team, we're one of the largest logistics companies and customs brokers in the world, and we had team working all weekend, paying overtime and taking care of people to get to put in extra effort this week for our customers.
So China's getting hit with 104%. Beijing comes back with more than 80% this morning on American imports. You're talking about this mad rush to get product out of China and out of Asian ports. Well, then what happens in a few weeks? Is it a mad halt?
Yeah, I mean, you saw that in the survey result that you posted there from Flexport's customers. We are seeing expecting quite a slowdown based on what customers are telling us. And it's not necessarily that there's 3 possible reasons for this, in my view. Number one is that people knew this date was coming for a long time, and they're well stocked. They imported a lot of inventory ahead of time at the lower duty rates. So that part, they're going to sell through those stocks. 2, as I mentioned in the tweet, there's a lot of uncertainty. I think people believe that tariffs may come down. The White House, the administration has been signaling in all kinds of different ways that they're making deals. Japan, Korea, like a whole bunch of countries have come in and said they would drop U.S. tariffs in exchange for a deal. So if you think duty rates are going to drop from these high levels, then that would make sense. And then the third possibility, and the one that's the most worrisome, is the business model isn't working as well. I mean, people are going to have to raise prices because these tariffs are so high. There's no other choice. And, you know, the one thing we know from economics is if you raise prices, you sell less stuff.
So, Ryan, when do you think that could actually happen? Prices going up?
Oh, we've already seen that start to happen. So it's looking like you look at our customers and you check all their e-commerce websites, we're seeing about a 5% increase in price that's already taken place. So even though the tariffs haven't started to get paid, they know it's coming, starting to factor that in. I assume prices will go up even further from there as they, the tariffs actually start getting paid, washed through the system, fed into more of the analytics of these companies.
Ryan, there are a couple of different pieces to this. On one hand, it's the tit-for-tat headline tariff rate. There also is this matter of fees on Chinese-built vessels, which potentially could also add to some of the costs. We're just getting news now from the Wall Street Journal that right now there is a revision to that where the new plan is to base the fees largely on vessel capacity, which could make it a lower fee. But from a broader standpoint, given China's dominance in the vessel creation, building of some of the shipping fleet, how significant would that aspect of some of these new levies be?
Yeah, so that's expected on April 17th is what we're expecting when a new ruling will come out about these fees that have been proposed on Chinese ships. It could potentially catastrophic. I mean, I can kind of overuse that word these days with how brutal the tariffs have been on customers. But the danger here is that they are, and we'll see how the new ruling comes out. I haven't read that Wall Street Journal article yet, but the way that they've been proposed is that it would be a per port call fee. And that would mean that it would create this real incentive for the carriers to skip the smaller ports because then they would pay less fees if they just make one port call at a major port instead of going to the small ports. Today, the ships will tend to, on the West Coast, they'll stop in Seattle, Oakland, LA. They'll make 3 port calls. So if you skip a few of those, obviously really bad for the jobs, both the port workers and the warehouses and everything around there. Very bad for importers and exporters, importantly, that are now having to truck their stuff all the way to LA instead of using the local nearest port to them. And then what you'll see is congestion at the major ports. And we saw that in COVID. LA just can't keep up with that kind of surge in volume. LA, Long Beach will get congested. New York, Houston, those are kind of the major ports on each coast. So you will see a lot of congestion in those ports. So yeah, hopefully they rework that. Looking forward to that. I've been pretty active, pretty vocal on the internet that this is kind of a crazy rule that's going to really hurt America's exporters and be self-defeating.
Ryan, just a final question. Busy week for you. Incredibly busy. How quiet might the rest of the year be?
I hope, we thrive off of this, man. I mean, I don't, normally you don't invite your customs broker on television. So we're enjoying the fact that we get to be more valuable for our customers, show up, work hard. Like that's why we work in this industry. It's always pretty exciting, but rough for our customers. We're trying to do everything we can to help them work through this because a lot of their business models have been turned upside down overnight. And, yeah, I mean, there are some things that we can do for them, but a lot of it is trying to be as informed as we can be on top of what's happening and then working on strategies and solutions for them in real time.
Existential for some of them, I'm sure. Ryan, appreciate it. Thanks for making time for us. Ryan Pedersen there of Flexport on the situation at the moment. I'm not sure how many people are aware that was actually how this worked, that it might be a number of weeks before you see that first ship arrive from China that has to pay the tariffs that went on overnight.
Right, because if already you are sitting on the sea, you have a little bit of a window room and you have some space. What I would also say is de minimis. These packages under $800, Shane, Temu, you see these teenagers buying off Instagram. Not only did the Trump administration close that exemption, if you're buying those packages, that tariff went up to 90%.
Those margins are like that. For so many of these companies, what we've seen overnight is truly existential. In the bond market right now, yields are up by 17 basis points on a 10-year. The 10-year at the moment, 4.47. From New York City, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Frans, every weekday, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Getting some corporate reaction this morning. Delta Airlines pulling their guidance for the year ahead. Jamie Dimon at JP Morgan speaking ahead of the earnings release on Friday, speaking to the press here in the United States a little bit early this morning and saying this: a recession is the likely outcome, echoing the views from his economist Mike Ferroli. That announcement coming out over the weekend. That's the base case for that team now. I expect more credit problems. Not seeing defaults yet, but I expect them. That's on the credit cycle. That comes from Jamie Dimon just moments ago, saying this about hedge funds. Lots of deleveraging from other players out there too, not just hedge funds. So that speaks to the bond market moves that we're seeing as well, Lisa, that a lot of people are curious about. If you are just joining us, equity futures on the S&P 500 down across the board here. The opening bout 60 minutes away. Bond yields are higher by 15 basis points at the moment. The 10-year 445. The 30-year north of 490. Up by 13 basis points on the session so far. Let's get you some morning movers into that opening bell. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, Don. This has been a really tough morning for the pharmaceutical stocks, with last night, Trump saying that announcement would soon come on tariffs on the pharmaceutical sector. BMO writing that this shatters the illusion of safety that many had believed because sectors weren't included in that initial tariff announcement from the White House on Liberation Day. Maybe they would be spared. It seems not so. Pfizer shares dropping 4.4% to the pre-market. If they hold at this level and close at this level, it would be their lowest price since 2016. Now, you mentioned the earnings. Let's just quickly go through those, because we got one playbook from Delta. Those shares up about 1/3%, scrapping their full year guidance, saying that there's too much uncertainty to do so. We will update you once we do have that certainty. Also going further to say we're controlling the things that are in our control, and that is margin and cash flow. So they're cutting their CapEx. They're reducing their capacity for the year. Ed Bastian, the CEO, may be on the bright side, saying this isn't COVID, this isn't bleak, this is just uncertainty. We also heard from Walmart too. They, on the other hand, are keeping their guidance, both for this current quarter and the fiscal year of 2026. Now, the one area you do see tariffs come into it, they've widened that potential outcomes for operating income for this quarter to account for tariffs, but those shares down about 0.9%. John, they will report their earnings on May 15th.
Hey, Danny, thank you. The latest on Walmart there, the stock is down by about 1%. Easy to forget, but in the next 24 hours, you'll get CPI. You get CPI and PPI as well. Get some Fed speak too. Mike McKee can break it down for you. Mike, based on the Fed communication so far, they're not racing in.
No, they're not racing in. The Fed is keeping an eye on what's going on in the markets, but they want to make sure that the trades go through, that there isn't a disruption to market functioning. The fact that we're seeing volatility isn't going to make them happy, but it's not going to make them too concerned at this point. I've been talking to a lot of people in the markets this morning who basically say as U.S. markets open, it doesn't look as bad from a systemic point of view as it might when you're just looking at the price action. Futures trading for treasuries has been relatively calm, and we're not seeing big dislocations from a lot of people. So we have to keep an eye on what the Fed is doing today, but it doesn't look like there is an immediate need to step in. Now, Ian Lingen from BMO pointing out in his note this morning that we have a 10-year auction this afternoon After yesterday's bad 3-year, if we get a bad 10-year, especially signs that foreigners are not buying, then that could set off a significant market reaction. So things to keep an eye on.
Mike McKee, appreciate the update, sir. The breakdown of what to look for, not just the data and the Fed speak, but also that auction coming up a little bit later. I said it last week, that one morning you'd come in with equities down and down hard and bond yields were up. That was going to be the morning that would concern me. And I think it is concerning to see these moves in 10-year Treasury yields, up 16 basis points.
It's concerning a lot of people, and there's a question of what happens to this bond market if there is a failed auction or some sort of catastrophic outcome, and that's clearly gotten people concerned.
The Treasury Secretary, Scott Bessent, speaking at the moment at the American Bankers Association Summit down in Washington, D.C. When we get some headlines from that, we'll share them with you, but this is the man to watch right now. He's pushing the idea that you can negotiate some of this, but at the moment we're just seeing escalation, particularly between the United States and China. Sarah Wolf of Morgan Stanley writes, we revise our outlook for the U.S. economy in the direction of even slower growth and a sharp firming of inflation. Sarah joins us now for more. Sarah, good morning.
Good morning.
Does that constrain the Federal Reserve?
Puts the Fed in a very tricky position. They're going to be on this wait-and-see hold. We're getting the FOMC minutes later today. Likely going to be a non-event. Chair Powell made it pretty clear on Friday that he's highly attentive to the outlook, but they're not going to move until they get some deterioration in the hard data. The soft data is not enough. So what gets the Fed to move by more? Markets are now pricing in over 4 cuts for this year. It's financial conditions. We're talking about the deleveraging that we saw yesterday. Credit spreads are widening a bit. There's a little bit of concern about what's happening in the private credit market as well. And so I think the Fed's going to be very highly attuned to how the financial plumbing plays out, and that could be what gets the Fed to move.
We've mentioned it a few times, that period back in 2018, in December 2018, when high-yield credit really started to break down, spreads started to widen aggressively, and issuance completely froze. The Fed did step in. Are you seeing parallels to this moment, or are they constrained by the inflation story in a way now that they weren't back then?
They're definitely more constrained today, right? I mean, we were dealing with 1.5% inflation in 2018, so it was much easier for the Fed to be delivering cuts. They already were ready to be a bit more on an easing bias. Right now, the Fed is treading a very fine line where they're worried that long-run inflation expectations are going to be drifting higher with growth slowing down. It's a very tricky position for the Fed. But at the same time, if you have some type of liquidity issue, that's what could really start to cause the economy to tumble very fast. And so you see that the Fed will be very focused on the hard data when they can be, but then be very focused on financial conditions when they need to be. So we could start to see a little bit of a shift in Fed communication if financial conditions continue to deteriorate.
How much is an offset, potentially, of lower oil prices, given the fact that people are so worried about pricing pressure, and that this is a huge tailwind, potentially, if oil prices are going the lowest since 2021?
Yeah, I mean, oil prices are a tax on households if they go up, and they provide quite a bit of relief on the way down. And when we think about who's getting hit the hardest by tariffs, it's lower middle-income households, and that's where gas prices matter the most. And so we do see that lower gas prices are going to free up some discretionary spending for these low-income households. But at the same time, the fear is still there, and the price increases that we're going to see from tariffs across broad goods and maybe even trickling into the services sector in the medium run is really going to win the day over gas prices. So we might be getting a little bit of alleviation right now, but we've done some work on price sensitivity, income sensitivity, and households are going to be pulling back on durable goods.
Even the high-end consumer?
Even high-end. We're seeing it already with consumer financial expectations for high-end consumers has fallen more than lower and middle-income households. Think about the wealth effect. We've seen a $10 trillion loss in wealth over the past couple of weeks. That has a really significant impact on how high-income households feel. And it's not even the loss of wealth. It's the volatility. It's the uncertainty. Where are we going from here? What is going to cause markets to start to calm down? And I do think that even though tariffs are really hurting the good side of the economy, it's the wealth effect that will start to bleed into the services side of the economy. And we see that things like air travel, package tours, hotels, those are the sectors that take a hit.
Payrolls came out on Friday. They were decent, they were fine. A lot of people said it doesn't matter, they're going to get worse. That seemed to be the response that we had on this program. Perhaps they're right, maybe they're wrong. I don't know, but when we get CPI and PPI over the next few days, are we going to have a similar response to that data?
I do think there's a little bit of a dismissal of the incoming data because it's not incorporating the impact of these new policies. There was barely a peep on Friday after a strong payroll report. I think what we know, though, is that some of the weakness that we're getting in the GDP numbers for the first quarter are are likely overstated because of some of the payback in January and February from strong holiday sales, from weather-related events. And so payrolls are showing that we're starting on stronger footing than people thought, right? So maybe we have a little bit more room to fall before we actually hit a recession. But I think at the same time, markets don't really care, right? We're waiting on when the federal layoffs really start to bleed into payrolls. We're waiting for tariffs to start to weigh on businesses, CapEx, and hiring plans. That's all yet to come. And so similar to Friday, I think there's going to be a little bit of a dismissal of the inflation data that we get over the next couple of days.
Are markets getting ahead of themselves? Are people pricing in the worst case scenario, not accounting for some of the offsets that a growing number of companies are coming up with, whether it's getting around some of the tariff plans in a lot of different creative ways, whether it's offsetting some of the margin of some of the increase potentially in price with margin reductions, trying to capture market share. I mean, a whole host of things that could potentially offset how much of a shock this is to the broader economy.
Yeah, I do think that there's possible upside scenarios. I mean, financials are a good example of this, where deregulation will eventually start to benefit financials, and capital market activity will start to come back online. So maybe something like financials is being overly punished by some of the medium-term volatility and news that are coming in. But when I think about longer run, what the stock market is really reacting to is just, what is the game plan? Are we trying to raise revenues through tariffs to offset tax cuts? That means tariffs are here to stay. Are we trying to open up global trade, and so tariffs are going to go down to zero? That's a huge upside scenario. Or are we trying to stimulate business investment in the U.S., so tariffs are really just for negotiating? And I think, businesses could try to find these loopholes. We saw it during the 2018-2019 trade war. But until we have real clarity about what the end goal is for this tariff policy, it's going to be very difficult to see a meaningful recovery in markets.
Sarah, appreciate your time. It's good to see you. Sarah Wolf there of Morgan Stanley, breaking down the latest and looking ahead to that CPI and PPI data later on this week. Equity futures on the S&P down across the board. We're down 2% on the S&P 500. On the Nasdaq, we're down by 1.8. On the Russell, by 2.7. In the bond market, not a source of comfort. Bond yields at the moment up another 15 basis points on a 10-year, of 14 on 30s. The headline of the morning so far: the tariffs go on overnight, as expected. The retaliation from China, raising tariffs on U.S. goods to 84%. To discuss, I'm pleased to say that joining us now is Risha Sharma of Rockefeller International. Risha, welcome to the program, sir. We are trying to work out what this Federal Reserve should do. Should the policymakers be stepping in and providing support, or should they watch and wait to see how this plays out?
Well, I don't think there's any case for the Fed to cut interest rates given its dual mandate just now, because as I wrote in my FT op-ed this Monday, which is that the Fed has missed its inflation target for 5 years in a row. It will do so again this year and the year after that, and possibly won't get to the target now for the next couple of years, even if it does nothing at this stage. And inflation is a big concern for Americans. And the rise in consumer prices over the last 5 to 6 years has been such that it has offset the entire undershoot of the 2% inflation target that we had last decade. So if you go back to the year 2000, over the last 25 years now, what you will see is that over that time period, consumer prices today are higher by about 16% than they would have been had the Fed been meeting its 2% inflation target over the last 25 years. So that's a serious miss on inflation, and I think it's aware of that. And given the fact that some inflation expectations are already elevated, to add fuel to that fire would be a mistake. So I think that the Fed needs to be true to its mandate, and it needs to sort of, at the very least, watch. And so far, there's been no evidence that its policy has been overly restrictive.
The pushback that I've heard over the past week, and I'd love your response to it, goes a little something like this. They should focus on the downside risk to growth and not the upside risk to inflation, because anxiety around the labour market is so much higher. We don't have sufficient tightness in the labour market that would drive those second-round effects, higher wages, etc. What would you say back to that?
Well, this has been the same easy money crowd, which has been, which is always calling for lower interest rates. So I think that that's been the real problem. One of the basic problems of the U.S. economy is that it's been fed on a diet of easy money for far too long, whether it's monetary policy or fiscal policy. And I think that's coming back to bite the U.S. And what's happening today is a demonstration of that, which is that I can't remember seeing a day in my memory where on the US markets, all three major indicators are down: US stocks, US bonds, and the US dollar. So there's a real loss of confidence happening here as far as the US is concerned. This is almost like the kind of scene that I see in emerging markets, that, where you see cross assets declining together like this. And in emerging markets, I don't think any central bank would think about cutting interest rates in such an environment.
Do you think that we're getting a little ahead of ourselves with trying to give a narrative to the move in markets right now, given that there are basis trades unwinding and hedge funds that are deleveraging?
Well, it's still unprecedented. I agree that there's nothing that sort of extraordinary going on. If you look at the scenes we have seen in 2008, that kind of market panic, we are far from that, but we don't want to get to that point. So I think that the whole issue here is the fact that let's acknowledge that we have seen a very unusual move in asset prices, and that this accident in a way was waiting to happen. As you know, that at the end of last year, I had sort of called this the mother of all bubbles, this American exceptionalism trade where everybody was flooding into the American market as if there was no other market in the world to invest in. 80% of all equity market flows around the world this decade went into just America. So it's this big unwind taking place, I think, of that bubble. Now, you can argue that it would have happened regardless of Trump and tariffs, but his moves have obviously precipitated this. But as someone put it, that the air is coming out of that balloon, but that air was put in the balloon before that. And as I've argued in the past, the combination of very easy monetary and fiscal policies is what has got us into this place today.
How much further does it have to go then, if that's the theory that, yes, this is partly because of what's going on right now with policy uncertainty and the actual policies being put in place, but it also has to do with the buildup over so many years that you call a bubble. How much further do we have to go to create a level that you feel more comfortable investing in?
Well, I think that this marks a major regime shift, which is that the US market had outperformed the rest of the world for 15 years, as you know. And in the last couple of years, that reached what we call a parabolic stage, where it just went completely vertical, where US markets totally disconnected from the rest of the world. They, in fact, were sucking capital out from the rest of the world. So I think that this has many years to go, that what we're seeing today is the opening act of this major trend reversal in capital flows. But this is a multi-year trend. That people love to say that don't bet against America. The American stock market eventually always comes back and has been a great performer over very long stretches of time. All true. But if you look at those very long stretches of time, which go back to the year 1900 when we have data, that the US stock market in 6 of the past 11 decades has in fact underperformed the rest of the world. And we've just had a 15-year incredible spell of US market outperformance, with both the dollar doing well and the US stock market doing well. I suspect for at least the rest of the decade, both the dollar and the US stock market to significantly underperform the rest of the world. So I think that this is a regime shift precipitated by what Trump is doing, but something which predates him.
In this regime shift, do you think we need to start worrying about potentially a firm blowing up like Melvin Capital Management did in 2022?
Well, I think, there is a lot of leverage out there which we'll only know about when this happens. Like, what are the marks today for private credit, for example? Have they, started marking their assets down or not? Private equity. So I think that there is a lot of follow-through action that we have to see. What we've seen so far is only in the public markets. My concern is that the longer this lasts, which I think it could, then you have to sort of start marking down private assets, and then we have to see what really happens, because that's where a lot of the buildup in excesses has taken place. So I think that, yes, we are going to find out where all the leverage is, and that's what the Fed should be doing now. It should be out there looking at where will this stress emerge of this big decline in public markets, because so much of the froth and so much of the excesses are lying in the private markets outside of the regular eye.
Second time we've heard that this morning. Risha Sharma of Rockefeller International. Risha, appreciate your time, sir. Thank you very much. The dash for cash. Jefferies this morning. Treasury market volatility is intensifying. It's starting to resemble the spring 2020 dash for cash. It's never a good sign. That's what we're seeing right now off the back of just extreme risk aversion driven by uncertainty around the US economy.
Sell what you can, not what you want. That is not what you want to see. And that was what spurred the Fed to really come in a big way back in 2020. This is a different type of shock, and it's not clear exactly how much ammunition they have.
Bond yields up again this morning by 14 basis points on a 10-year and a 30-year yield. The 30-year this morning, 490 in the equity market on the S&P 500 at the moment. Equities are declining across the board here. On the S&P, we're down by 1.5%. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Oil is sinking to a 4-year low. Brent and NYMEX futures both below $60 a barrel for the first time since 2021. President Trump's tariffs are forcing analysts and traders to rethink demand outlooks. Both Goldman Sachs and Morgan Stanley have at least halved their outlook for oil consumption growth this year. The Wall Street Journal reporting moments ago that the Trump administration is revising its plan to impose port fees on Chinese-built vessels. The new plan will base fees on vessel capacity, resulting in lower fees for smaller ships. U.S. Trade Representative Jamieson Greer told the Senate that the revisions are based on public feedback. A former Meta executive plans to testify before Congress that the company briefed the Chinese Communist Party on emerging technologies, including AI. Meta has denied the claims, writing in a statement, Mark Zuckerberg was public about our interest in offering our services in China, and details were widely reported beginning over a decade ago. The fact is, we do not operate in China today. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Great work this morning, as always. Up next on the program, we'll set you up for the day ahead. From New York, you're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equities at the moment negative across the board, recovering somewhat though as we work our way towards the opening bell. We're down 1% on the S&P. On the Nasdaq, we're down by 0.6. On the Russell, we're down by 1.7. Your day and week ahead looks like this. Later on this afternoon, 1 p.m., the Treasury auctioning $39 billion of 10-year notes. Look out for that because yields are up at the moment by 16 basis points. Then later, Fed minutes. Then at 2:30, the president signing more executive orders. Tomorrow, CPI, plus another round of jobless claims. On Friday, PPI and UMich sentiment. Plus, earnings season continues. The banks, JP Morgan, Wells Fargo, Morgan Stanley, all reporting on Friday morning. Joining us now from the nation's capital is Tyler Kendall. Tyler, welcome back to the program. So, big action overnight. Big retaliation from China. How is the administration responding to that snapback from China?
Yeah, hey, John. Well, Treasury Secretary Scott Bessent, in an interview a little while ago, said that he was confident that the trade dispute with China could be reached at the highest of levels. He said that President Trump has a good working relationship with Xi Jinping, though we should note that there has been a call between the two leaders since President Trump was inaugurated. And just yesterday, President Trump said that he was waiting for a phone call from Beijing. Importantly, though, Bessent went on to say that everything is on the table when it comes to China. When asked if the U.S. would go as far as removing some Chinese companies from U.S. exchanges, he didn't rule it out and went on to talk about the potential need for more export capital controls. Now, I will add that we did potentially see a shift even more towards the optimistic, not necessarily with China, but with some other trade deals. The secretary said to expect a, quote, rapid succession of deals. He named Japan, South Korea, India, and the U.K. as countries that this White House is all engaging with.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Look out for more coverage from Washington, D.C. with Tyler throughout today. This from the Treasury Secretary just moments ago. There is a little uncertainty about the economy. Still, we are in pretty good shape. The message from the Treasury Secretary this morning.
Well, I would say there's a lot more uncertainty about the economy, and that is stemming from policy in Washington, D.C., and it depends who you ask in the administration. Me, Josh Wingrove, Saleha Mohsen have a story out today that actually Peter Navarro wanted it to be even more aggressive when it came to these tariffs. Depends on who you talk to that is surrounding the president on potentially where this is going to go. Negotiation or new rules of the road.
A little uncertainty. I think a lot of people might disagree in markets right now. It seems like uncertainty, you cannot overstate that. The commentary from CEOs is getting more pointed. And I think that that is marking a shift after they remained on the sideline as a likely outcome, and saying that he has put some headcount controls in place. Not yet forcing cuts to the workforce, but reflecting that this will cause credit problems. They have lost a few deals to potentially local businesses. You're just hearing a little bit more detail from some of those executives.
Bracing for another wild day in financial markets. Equities recovering just a touch, still lower by 0.8% on the S&P 500. The bond market is not recovering just yet. Bond yields are higher by 15 basis points on a 10-year maturity. Coming up tomorrow, we'll catch up with Russ Kostrick of BlackRock, Stuart Kaiser of Citi, Wally Adeyemo, the former Deputy Treasury Secretary under President Biden, and Erica Najarian of UBS, looking ahead to those bank earnings on Friday. CPI is just around the corner. Just around a corner, more volatility, I'm sure. From New York City this morning, good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Why is Baltimore so important to you? It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, it is tariff day. 30 minutes until the S&P 500 opens near bear market territory. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, China raises tariffs on U.S. goods to 84%, sending global stocks further in the red.
As China raises the stakes, crude collapses, forcing analysts and traders to reassess their oil demand outlooks.
And from retailers to airlines, corporate America responds as Trump tariffs kick in. All of that and more coming up. Let's take a look at Delta pulling its outlook due to uncertainty for travel demand. Shares actually a little bit higher right now, Matt Miller.
Yeah. Interesting move there. Walmart, on the other hand, reaffirmed its first quarter sales guidance, and you can see the shares are a little bit lower right now.
I'm looking at the pharma industry, another tariff set of stocks to watch. Pharmaceutical stocks plunging after Trump said he will soon add tariffs targeting the sector. Pfizer down 3.6% pre-market. And last night, the president commented on the trade war with China, and this is what he said before Beijing implemented those 84% tariffs on the U.S.
They don't want tariffs on themselves. And it's very simple. We're making deals and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%.
Let's now get the latest on the White House trade negotiations with Bloomberg's Tyler Kendall. Since we saw that China retaliation here, we also saw Scott Bessent come out and react to them a little bit. How do we know about how the U.S. administration will respond to these newest Chinese tariffs?
Yeah, hey, Shonali, it appears this White House is sort of walking that line between a negotiation and escalation. As you mentioned, we heard from the Treasury Secretary Scott Bessent earlier today in an interview who said that he was confident that the dispute with China could be resolved at the leader level. He said that President Trump and Xi Jinping do have a good working relationship together. We should note, though, that there hasn't been a call between the two leaders since President Trump was inaugurated. And just yesterday, President Trump said that he was waiting for Beijing's call. Importantly, the Treasury Secretary also said that everything is on the table when it comes to the dispute with China. Even when asked, the U.S. would go as far as removing Chinese stocks from U.S. exchanges. He spoke about potentially the need for some more export capital controls there. But I will mention another update that he did give us, which was that he said that we should soon expect a rapid succession of deals, not necessarily with China. He named Japan, South Korea, the U.K., and India as countries that the U.S. is currently engaging with as they all try to figure out exactly what this White House wants to see in order to clinch a deal.
Well, let's talk about that a little bit more, Tyler. We've heard from the Treasury Secretary just in the past 10 minutes saying that Europe would cut its own throat by aligning with China. He also said that, to your point, he sees deals with allies, and then the hope is that they can approach China as a group. Who counts as an ally in this situation, and how fickle is that allyship?
Right, that's a great question. And it's actually something that President Trump was asked, and he's previously said that sometimes allies are worse than adversaries when it comes to their tariff barriers against the U.S. President Trump was also asked yesterday whether or not he was concerned about a potential realignment when it comes to the markets around China instead of the U.S., and he brushed it aside. Now, it is important to mention, particularly with these allies that are trying to strike these deals, it is becoming increasingly clear that it is going to take a lot more than just eliminating tariff barriers. That's why we're going to be closely watching, of course, the non-tariff barriers that this White House talks so much about. In fact, you had the USTR Jamison Greer on Capitol Hill yesterday, and he said that his message to countries was if they had any other ideas on how to achieve reciprocity, then the U.S. wants to hear from them, signaling to us that some of these deals might end up getting a little creative, as President Trump says that he's not looking for anything off the rack. He wants to see these all specifically tailored to exactly what these countries can bring to the table, whether that could be energy imports, for example, something that President Trump has floated specifically for the European Union, or those other taxes that we talk about often, such as the VAT or digital services taxes.
All right, Bloomberg's Tyler Kendall in Washington reminding us that we may still have allies. Energy among the most volatile sectors today. Take a look at crude. At one point, it was down 7%. Joining us at the desk is the close team, Alex Steele and Romaine Bostic. So, Alex, you've covered energy for years. What do you make of these moves?
Yeah, it's really bad. It's bad in terms of the price level, but it's the speed, right? So if you're an energy producer, you may not care right away about the actual price, but the speed with which we re-rated, $15 in 5 days, that's really brutal and really hard to then make CapEx decisions. We're still keeping the lights on, like we're not at that level, where that would be more in the 40s, and obviously the big guys can handle this a lot better than the small guys. But in the Permian, for example, you're looking at break even at about 65. Like we are now below that at this point.
How much worse does it get in the event of a recession? Because we came into this year and energy was supposed to be a huge sector. Yeah. Drill, baby, drill. You're seeing energy one of the worst performers already, even heading into the overnight drop.
I can tell you no one is drill, baby, drilling right now. Period. Full stop. When it comes to how much worse it can get, so Energy Aspects, Emery Descent looked at 1 million barrels of oil a day could be cut from demand due to recession. But you take a look at the futures curve, so CCRV on your terminal, and the curve isn't indicating that yet. The front end of the curve is still higher than just a few months from now. So demand is still okay. It's just the anticipation of losing that demand that's the issue. Remember, Saudi Arabia is also allowing OPEC Plus to put a lot more barrels of oil in the market, particularly when it comes to May. That's on purpose. The Saudis don't want Iran and Kazakhstan to keep cheating, right? So that's on purpose, but that's going to weigh on the price. But it does take away a little bit of that market stability lever from the Saudis.
So Alex Steele covering the energy sector, the global energy sector very closely. Romaine Bostic, let's talk about a few other industries, because we did hear a little bit from corporate America this morning, their response so far to the tariffs. Delta and Walmart come to mind.
Yeah, and Delta was a big one. I mean, we talk about what a difference 3 months makes. I want to go back to early in January when Ed Bastian, the CEO of Delta, told investors that he was very confident in the company actually exceeding some of Wall Street's targets for full year revenue and full year profitability. Today, basically saying there is no visibility to stand by that guidance. And well, why would it? There was an interesting report out just last week by OAG, which tracks flight data. International inbound travel right now is actually putrid. In fact, we look at inbound travel from the U.S. to Canada, forward bookings down 70% on a year-over-year basis for every month going to September. We had Clint Henderson from the Point Sky on yesterday. He said leisure travel is down, as well as business travel is down, and you get a big sense here of why Delta would pull its forecast.
All right, we have Walmart sticking to its forecast in the face of inflation due to tariffs.
That's what they do, Matt, and this is exactly what the CFO said, is it's times like these are when Walmart really does shine. Now, the big question is how do they do that? They seem to suggest that they are willing to take price, meaning that they're going to absorb the costs and not necessarily pass it on to the consumer. They also made it clear they are going to take some mitigating steps to try to reduce the burden on them. It'll be interesting to see how they manage this, but it's really a tale of two companies right now, one that does typically thrive in economic downturns and another, the travel industry, that typically struggles. pharmaceuticals.
I want to go back to the other thing we were talking about, pharma in particular.
Yeah,
Katie, I know
drugs.
you watch this really closely. This idea that there are plants in Ireland for some of these companies. Then you think about generics as well coming out of the other side of the world. Where are you most concerned or seeing the pain right now?
Well, I mean, right now, everything in the pharma space right now is getting hit. We're talking about huge drops in U.S. pharmaceuticals, huge drops in European pharmaceuticals, huge drop in Asian pharmaceuticals. We talk about global supply chains, and there's been so much focus, Shonali, on the auto sector, but people forget the pharmaceutical sector is so intertwined globally in terms of where things get sourced, where things get produced, and ultimately where things get sold. That's not easy to unravel. And remember, just about a week ago, most people thought that the pharmaceutical sector would be spared from this. But you heard those comments from Trump that you guys just played at that event last night. He seems to be saying they're the next in line here for some sort of tariff or trade remedy. So investors really, there's not a whole lot of places to hide.
You know what helps? Lower oil prices. Just saying. For all of those stocks.
Can I tell you, all day long she just talks my ear off about oil. Yeah, well, yesterday it was cold, so I got a little reprieve from
the
oil.
person on the equities market show.
All right, guys, great roundup as always. That is Romaine Bostick and Alex Steele. You can catch them on the close at 3 p.m., but don't go anywhere right now because we have a market open to get through. You take a look at the futures picture. It's not that bad relative, at least to the past few days. The S&P 500 down about 0.4%. We were looking at pre-market losses of 1.9% earlier, so a little bit better there. Now, coming up, we'll go deeper into Delta, pulling its full-year guidance as uncertainty surrounds global trade. We'll speak to Tom Fitzgerald, TD Cowen Airlines analyst, next. This is Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. And that's not good for the economy. Growth is really critical. And I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Let's getting out of high interest. Look at what's making headlines around the world. Treasury Secretary Scott Bessent is playing down a sell-off in U.S. Treasuries, saying there's nothing systemic at play, and he's attributing the moves to a normal deleveraging process. Longer-dated Treasuries have borne the brunt of declines in the market for U.S. government bonds in recent days. He is also warning China not to try to devalue its exchange rate in retaliation for U.S. tariff hikes. Citadel Securities is proposing a system that would let it process trades for a large swath of banks. The proposal aims to start with U.S. Treasuries, interest rate swaps, and corporate bonds, and could expand to other markets. Citadel says the system would give it more insight and leverage in the market and would help smaller banks compete with the likes of J.P. Morgan and Goldman Sachs. And Delta Airlines withdrew its full-year financial guidance thanks to uncertainty surrounding global trade. It's a stark sign of the turmoil rippling across corporate America from President Trump's tariffs. Several airlines warned last month the volatility was pressuring domestic travel, and Delta CEO Ed Bastian said he's monitoring if the pullback will bleed into key areas like premium and international demand. Shonali?
Something to watch closely, Matt. We should say that they also still anticipate a profit in 2025, which is why you might see some green in the stock. Let's take a deeper look at Delta. Here with more, Tom Fitzgerald, TD Cowen Airlines analyst. He has a buy rating on the stock with a $45 price target. We have seen Delta take a lot of pain this year, so far down 40%. We have analysts saying that this sector, this airline sector, is really a sign of what's to come with the U.S. consumer and business spend. What is the biggest risk to you at this juncture?
Yeah, for an airline like Delta and the other large legacy carriers, it's that the risk starts spreading to international and premium demand. Those parts of their business held in well in Q1, and they expressed optimism on their performance in 2Q. But if the broader economy starts trending downwards and we see weakness in premium and international, that would be very concerning for Delta's margins and United Americans.
Yeah, it'll be fascinating to see if global demand holds up and for how long. But I want to talk about what we can maybe extrapolate out into the other airlines. Delta, the first U.S. carrier to report earnings, pulling their guidance. That's been the expectation across industries. Tom, when you think about the other carriers who have yet to take the stage, would you expect to see similar guidance pulls from them?
I would, and I think there's a more negative read-through here for some of the other domestically focused carriers, as we expect Delta and the other full-service carriers to compete pretty aggressively for basic economy traffic. So that portends poorly for a Southwest, JetBlue, Frontier, Spirit Airlines, all the domestic leisure carriers.
It looks like, Delta is pulling its guidance, and Ed Bastian says he's on recession footing. He told CNBC, I believe this morning. However, oil prices, fuel prices are coming down dramatically at the same time as the labor market is softening. Aren't those the two most important cost inputs for an airline like this, for any airline?
They are, a lot of the labor force here is unionized. Less so for Delta, but definitely very much so for the broader industry. So there's a lot of long-term contracts that are underway regardless of the undulations of CPI in the broader economy. But fuel coming down definitely helps. And we expect a lot of airlines to work judiciously to lower cost as we move through the year. We might see a slowdown in maintenance spend as more older aircraft are retired rather than putting more cash in to keep them operating.
Well, Tom, that's where I wanted to go, because just to meditate on those comments from Ed Bastian a little bit more, he said specifically that they're acting as if we're going into a recession. I was wondering what specifically that means. You mentioned, maybe deferring maintenance costs. Would we expect them to be cutting flights and things along those lines as well?
Absolutely, and that takes a while to play out, but you see it in a couple forms. It could be lower utilization, so flying your planes less hours per day, and it could also just be parking older aircraft. So Delta and United, we've written about this. They have a pretty large amount of aircraft that are 24 years or older. So some of those aircraft that are very long in the tooth, like 30 years or more, those are good candidates to get retired, and that gives them a lot of optionality in this environment. So if demand is better than expected, they can keep them operating. If it's worse, they can send them to the desert. And other levers could also include cutting the worst performing markets, maybe leaving markets entirely, things like that.
I want to go back to something you were saying earlier, Tom, about the premium demand. That would be a big issue if stalled. What would it take to get there? If you look around the economy and are looking for signals that would start to dent demand, even from higher income customers, when does it stop?
Well, I mean, the stock market being down is a big indicator. I think the wealth effect has been a positive tailwind for premium demand over the last, in this post-COVID cycle. So if we continue going into a bear market in risk assets broadly, I think you could see that start to bleed into demand. Some of the airlines have talked about baby boomers being a really strong source of demand, especially in the premium cabin. And I would imagine the negative wealth effect to be acutely felt in that age cohort.
Yeah, absolutely. After $10 trillion have been erased from this stock market. Tom, thanks so much for joining us. Tom Fitzgerald of TD Cowen. Our airline coverage continues in the next hour. We'll be joined by the CEO of Air France, Ben Smith.
I do want to talk a little bit more, though, about those comments from Ed Bastian. I know they were on a competing network, but I think they're really interesting. The fact that they're behaving as if they're in a recession.
And so are their competitors, he said.
Exactly. That's kind of how this becomes a self-fulfilling prophecy. If you have a bunch of companies behaving as if they're in a recession and taking actions that would reflect that, that kind of...
Well, Larry Fink told Eric Schatzker a couple days ago that all the CEOs he talks to says they are in a recession right now.
But to harp on a comment that Katie had just made...
Don't harp on it.
You could talk yourself into a recession, right?
Yeah. Well, that's what I'm saying, yeah.
Yeah, the fact that you have businesses stalling activity, behaving that we're in a recession. Also, Larry Summers talking about the potential of a crisis. I mean, some doomsday mentality just puts people on pause.
So that's the C-suite read. It's interesting, of course, we'll have to watch the sentiment surveys closely to figure out how consumers actually feel. But we'll discuss all of that and more because less than 12 minutes until the opening bell, we'll begin this trading day with Gabriela Santos of JP Morgan Asset Management. She joins us next. This is Open Interest.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Well, Goldman Sachs, for one, is beginning to see opportunity with the S&P 500 closing below the 5,000 mark, we had Goldman partner John Flood saying that long-duration investors will likely get aggressive buying this dip if the S&P 500 continues to fall, especially around 4,500. Let's ask Gabriela Santos. She's Chief Market Strategist for the Americas at JP Morgan Asset Management. Great to have you with us in studio. So Goldman sees opportunity below 5,000. That was based on conversations that they're having with their longer-term investors. Take us into the conversations that you're having with clients, whether folks are scared right now or whether they're also sensing some opportunity.
So I think it's a mixture of defense and offense, and all coming from a starting point of very unbalanced allocations. And this is true across retail, institutional, U.S., global investors. There was a very heavy focus on what had worked, namely U.S. equities, the growth style, and mega cap tech. And I think that, plus high expectations, plus the change in policy, helps to explain this violent rebalancing that we've been seeing. So for some clients, that's still the journey. Reduce a bit equity exposure, have a more neutral allocation, stocks, bonds, have more diversification beneath the surface, balanced value growth, U.S. international, look for other ways to play defense in portfolios. And then you may have some investors that do have a longer time frame that maybe feel like some stocks or some strategies they had high conviction in anyway are now a buying opportunity. But a lot of it's still concentrated, I think, on defense, rebalancing, and making sure that investors aren't off sides, because it still seems like there's plenty of uncertainty to digest.
A lot of uncertainty, and I guess we all expected President Trump to implement the most damaging parts of his campaign promises first. He can do that by decree. The good things like tax cuts and deregulation may need a little bit more congressional help. Are tax cuts still going to drive a rebound? Are these still impetus, since it's actually just looking like an extension of the status quo rather than something new?
I think that's a really important discussion that's going on in Capitol Hill right now between Senates and the House. This discussion around additional tax cuts, I think completely baked in after the Republican sweep started to get priced in September last year, that there would be a full extension of the 2017 Tax Cuts and Jobs Act. So no news for anyone, should that really happen, as it looks likely. The conversation, though, seems to have really increased and will increase further should the economy soften further, as we expect, about additional tax cuts. So will there be no tax on tips or overtime or Social Security or auto insurance payments? Will there be perhaps a targeted cut in the corporate tax rate? Or could it go even further and there be Doge dividends, meaning stimulus checks across the board? I think the more the tariffs bite, the more that looks likely. I just don't know if the bond market will like it, but maybe for stocks it could put a bit of a floor.
You know, how much is the bond market telling you how much more pain there is to come in the equity market at this point? We saw just this morning the 10-year yield is hanging around 4.4%, but it hit as high as 4.5%. Is it telling you that maybe right now we're seeing a relative calm in equities, that there could be much more to come? The VIX is still pretty close to 60.
Yeah, I think what we saw Monday, Tuesday in the stock market, yesterday giving up huge gains. That was the biggest gain that was given up since 1982. I think the open might not tell us much by the time we get to the close. But I think the bond market is telling us a message that it's concerned about the growth shock. Because even if you look at 5-year break-evens, they've actually come down. However, the bond market is also telling us that there's some other building issues. Maybe they're just unwinding of trades, but also some concerns around the fiscal that we mentioned. Those are still very much there, as well as maybe concerns that foreigners, either passively or actively, are not that interested in U.S. assets, including treasuries. So we've been having a lot of conversations about, yeah, sure, just extending some duration for the growth shock. It worked in February, but also adding other defenders during these moments.
Well, that's the thing. There's a lot of existential questions about 60-40 portfolios right now because your bonds aren't working the way they should. We'll discuss that next because Gabriela Santos is staying with us through the opening bell. You can see that futures off their worst levels of the session, but still down on the day to the tune of about 0.7%. The open is up next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are still seeing red arrows on futures. S&P futures down 0.6%, NASDAQ futures down 0.2%, although we have seen NASDAQ futures creep up into positive territory. We've been down in the S&P as low as 2, so a lot of movement again today in this market. You hear the opening bell on the New York Stock Exchange. A company called Mistress, which actually provides some sort of asset protection solutions, I think like physical asset, not financial assets. And then there's some kind of magician, Steve Cohen, ringing the bell. Maybe that's what we need today. He can make the tariffs disappear for everybody, Katie. In terms of the stock movement, it's really not that significant on the index level. What are you seeing in terms of individual movers?
Yeah, there's something poetic about a magician ringing the opening bell with the S&P 500 set to open near a bear market. I don't know what the symbolism is, but there's something there. I'm taking a look at Delta, actually, because we've seen a big reversal. Remember, this morning, Delta actually pulled its 2025 outlook due to uncertainty for travel demand. They are still expecting a profit for the year, but they're not able to specify at this point what it will be. And shares currently higher by about 4% right now, Sonali.
It's interesting. I've got a bit of a flip side story for you. Walmart reaffirming its first quarter sales guidance and still expects net sales to grow this year. But you are seeing Walmart rise not too much in this market, 1.7% at the market open, Matt.
All right, pharmaceutical stocks are another industry group that we've been paying attention to, plunging after President Trump said he will soon add tariffs targeting that sector as well. He just can't get enough of these tariffs. Still with us, Gabriela Santos, Chief Market Strategist for the Americas at JP Morgan Asset Management. Gabby, do we get through this alive? I mean, 10% plus tariffs, is that good for the U.S. economy long term?
So we do think it's quite disruptive in the short term, to be debated whether it's good for the medium long term. I do think it takes a while to truly understand how long they will stay in place, which countries, which products, are there exemptions, and ultimately how the domestic economy is able to rebalance. But I think what investors are pricing in is that clearly tariffs are being used everything, everywhere, all at once, for this bigger overarching goal of rebalancing several different aspects of the economy. We estimate that currently tariffs the U.S. is imposing on imports are at 30%, which you'd have to go back before 1900 to see something that high.
It's a massive tax hike.
It's a massive tax hike. It's not just on the consumer. I think to be seen during this earnings season, how much companies feel like they can pass on. Is it half the increase in tariffs? Is it just a quarter because demand's a little soft? But it gets eaten up along the way, and it has an impact on how much consumers as a result are able to spend, but also how much companies are willing to invest in big projects, including CapEx, hiring. So I think a lot of research analysts and investors are eager to get any kind of information about that from companies as we have the earnings season get underway here.
So to go back to Matt's first question, we are going to live, it sounds like.
We'll make it.
We're going to make it.
We always do.
Right.
We've had the pandemic. We've had the financial crisis. We will. What we see the market do is correct valuations, especially when there's so much uncertainty. It will take some time to truly get the dollars and cents impact on the economy and on earnings. So what happens in advance? The multiple contracts, spreads move higher to overprice that. We saw that in 2018, 2019 at a smaller scale during the first trade war.
Right.
So I think that's what we're doing right now, but the multiple had come from being very expensive. So we've had basically a bear market, but the multiple still at 18 times with no confidence in next 12-month earnings. Normally you have this like full fleshing out when the multiple gets to 14 times, 15 times.
So we've been here before. It's great context. Somewhere we've been before is 2022, when you had stocks fail, you had stocks really fall, down 19% on the S&P 500, and you had bonds just completely fail as a hedge. Did not work at all. It seems like we are in a similar environment over the past couple weeks. If that extends through the course of 2025, where do you hide out? What is defensive? What's a haven in this market?
There's no magic bullet, frankly, and we've been having conversations with clients since 2022 to make sure that portfolios learned the lesson from that period, which is that in this kind of, economic market environment we're in, bonds can't be the whole solution for diversification. They can be some, but not the whole solution. So examples of what worked in 2022, certain alternatives were up. And here, not just a mark-to-market issue, but more an uncorrelated behavior that's a feature, not a bug, of certain types of alternatives, specifically real assets, infrastructure, real estate, as well as certain types of hedge funds. Otherwise, for certain investors where maybe that's not an option or it takes some money to deploy, takes time to deploy capital, thinking about liquid alternatives, absolute return strategies or hedging strategies to minimize some of that downside.
I just want to be clear that the reason I asked if we would all live through this is that I'm getting those questions from investors. Let's not forget that $10 trillion have been erased in this stock slump. And Donald Trump, like on point right now with his latest tweet, maybe the best tweet that I've ever seen from the United States president. Be cool. Okay. Be cool, in all caps. Everything, Shonali, is gonna work out well.
You know,
be cool.
I want to focus on the coolness, I guess, of the S&P 500 right now, because you're looking at it erase so much of last year's gains. Certainly everything we've seen since the election, but we're back to levels we've seen in April and even January of last year. So a lot of pain borne by investors so far. You were talking about hedging strategies. I've seen investors take moments of calm in the market to actually load up on hedges. Would you do that at this point in time? Try to buy puts while they're cheap?
So what we see working really well, and you've reported on this, Katie, are around ETFs that offer systematic ways to hedge some of the downside. They sell some calls, so give up some upside, but they also buy some puts that are able to hedge on a quarterly basis some of the downside. Now, the strategies we feel with particular conviction can work here are not ones that are trying to time the market with selling calls, buying puts. Just systematic, quarter by quarter, giving up some upside to protect some downside. And that's a way to play defense, but also offense, because we will live, the market will price all this in, and it eventually will rebound. So that's a way to have kind of a best of both worlds approach.
I'm going to say the ticker. It's JEPI, of course. It's the JP Morgan Equity Premium Income ETF. It does exactly what Gabby said, and it's been really popular. And it's been popular even in bull markets, too. So it's going to be interesting to see what that translates into if we do sustainably enter a bear market. Gabby, we got to leave it there. It's always great to see you. That is JP Morgan's Gabriela Santos. Meanwhile, let's go back to this equity market and talk specifically about Apple. Among the hardest hit from this standoff between the U.S. and China, let's discuss with Bloomberg Technology co-host Caroline Hyde.
Extraordinary, a day of recovery in somewhat, a slight move to the green for Apple after more than $770 billion has been wiped off Apple in the last 4 trading days alone. It was the worst 4-day sell-off that we've seen since the year 2000. Why? Because 4/5 of all of the smartphones made by Apple are shipped from China to the United States. They're assembled in China. Yes, you might get the odd screen capability, the glass from Kentucky going back to China and then reassembled there. But 4/5 of iPhones still coming from China is why Apple is so much in the eye of the storm. And the fact that the numbers are extraordinary when you think about it more broad brush. $41 billion of imports coming from China to the United States were smartphones. It is the single most important import from China to the United States. And this is what we're hitting.
We also sell a lot of stuff to China, and I imagine that a lot of it goes into goods that they assemble and then send back, right? But almost $200 billion. China is the 3rd biggest national buyer of U.S. goods in the world.
Yeah, and then you slap 80% tariffs on going the other direction.
Exactly.
No wonder that you're seeing this tit for tat escalate. No wonder you're seeing such a dampening pressure on the growth of companies where they're withdrawing their overall earnings outlook. Delta, will that spill into some of the earnings that we start to get from the technology sector as well? But I really think that you're starting to see analysts saying, look, there is no way when Trump puts out a Truth Social post saying it is a great time to move your company into the United States, like Apple. I'm sorry, Dan Ives says that's going to cost you $3,500 to have an Apple iPhone. You've got Laura Martin, another key analyst, saying this is not going to happen, large part because we don't have the labor, you don't have the capability, you cannot start building that amount of manufacturing here in the US in that sort of time frame. Inventory has helped these companies. We have seen the biggest uptick in PC shipments over from China to the United States and inbound into the United States since 2021, since COVID, because everyone front-run this. Interesting that companies managed to front-run it from an inventory perspective. The market did not.
Caroline, we thank you so very much. That is Bloomberg Technology co-host Caroline Hyde. And coming up, pharma is on the firing line. President Trump says a major tariff is coming to the sector soon. More on that next. This is Bloomberg Open Interest.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Middle
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
All right, welcome back to Open Interest. To check on these markets right now, we have a rally on our hands for now. The S&P 500 up about 0.9%. Big tech leading the way. The NASDAQ 100 up about 1.5%. The Russell 2000 also getting in on the action. I will say we're coming off of 4 straight days of a trading range of 5% for the S&P 500, so we'll have to see how this one settles out. But it's time now for our top calls. Some of the analyst action in focus this morning, and first up, we have Apple actually getting upgraded over at Jefferies after its significant drop, with the analyst cutting his price target, though, thanks to those tariff risks. Next, Bath & Body Works getting upgraded as well to a buy over at Piper Sandler. The analyst says that the business is fairly well insulated from macro pressures relative to its peers. And finally, we have Ford getting downgraded to a sell over at Bernstein on those tariff risks. The analyst says that significant downside for the stock is actually not yet priced in, even though we've seen quite a wipeout. I do want to turn to pharma, though, because President Trump says that levies on pharmaceutical drugs are coming next.
We're going to tariff our pharmaceuticals, and once we do that, they're going to come rushing back into our country because we're the big market. The advantage we have over everybody is that we're the big market. So we're going to be announcing very shortly a major tariff on pharmaceuticals.
We're joined now by Sam Fazeli of Bloomberg Intelligence. And Sam, unpack this for us. Do you feel that tariffs will do anything to shift a very globally integrated supply chain back to the United States?
They might at some point, but just like everything else that we've talked about, I'm just listening to Caroline talk about Apple, not only will push prices up and costs up, but also it would be a while before you can do that, especially for the more complicated drugs that require a big manufacturing suite and then maybe the devices to go with them, like these Zepbound injectors. So it would take time.
One place that I'm particularly concerned about, Sam, is not just big pharma and the new big fancy expensive drugs. I'm wondering what the impact to generics will be when many of them are made abroad.
Yeah, so interesting, because you can read some of that questions or answers to your question in the US trade data, which I've just been looking at. So Mexico accounts for 33% of pharmaceutical imports into the US by volume, but for 1% by value. That tells you those are the cheaper active ingredient type products that are coming in. So Mexico is already obviously under tariffs, but pharmaceuticals have not been. And as soon as that happens, you're going to end up with a situation where those cheaper generics, where a lot of people rely on, and that's how you get drug prices down, are going to be the ones that are impacted first and most.
Sam, I want to ask, as usual, a broader question of you about the future of pharma. If these companies can't charge us, you know, they charge us the highest prices in the world. If they can't get that revenue, and if we're cutting off grants to Ivy League, to the best universities in the world, what does that mean for the development of drugs to beat diseases?
Yeah. Well, so Matt, you've just been reading my mind, I think, which is your special power, right? No, look, on the one hand, President Trump said that the US, which is correct, is the biggest by value pharmaceutical market in the world. On the other hand, although this wasn't in this speech, they're trying to curtail ability to price these drugs. And as we just saw, they didn't want to cover obesity drugs through Medicare, which is not a massive thing, but it's an example, right? And if you bring in the possibility that you're going to create what's called favored nation in the United States, then suddenly that argument disappears. So what's the point of bringing everything back to the US if you become a country like everybody else? And on the top of that, what you just said, this issue with allowing science to follow what it needs to do without cutting and without putting pressure on the types of research they do, that's one of the other problems.
All right, Sam, always great to get your perspective. That is Sam Fazeli of Bloomberg Intelligence talking us through upcoming potential tariffs on the pharmaceutical sector. You can see healthcare as a sector is still pretty deeply in the red, down 1.5%, even as you see the S&P 500 try to rebound. Coming up next, we'll take a look at the bond market because long-term yields soaring worldwide, with investors worrying about President Trump's tariff impact. We'll talk all things treasuries next. This is Open Interest.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is Bloomberg Open Interest. Quick check on what's going on in these markets. And you need to look every couple of minutes because of the volatility. We are now up on the S&P 500 about 0.5%, more than 1% on the NASDAQ. So tech stocks leading your way higher. Let's get a look at some of those tech stocks. NVIDIA right now up 3%, Apple up 3%. These are the two biggest companies in the world by market cap. So obviously when they rise, they pull the indexes with them. Tesla gaining a little bit today if you're long that. Pfizer is down. We were just talking about pharma. Walmart says it's going to stick to its guidance even with tariffs, and it's getting a 3.5% boost. ExxonMobil down 2%. The interesting thing here, I think, is yields. The U.S. 10-year at 4.35. The 2-year back up at 377. So we'll continue, Shanali, to see a sell-off in bonds, the likes of which we haven't seen since the pandemic.
Certainly a pretty historic moment. The scale of the moves are large, and there's some government bond auctions actually later today and tomorrow that traders are watching closely. But the Treasury's fire sale is sending long-term yields soaring worldwide. The yield on the 30-year Treasuries briefly soared above 5%, fueling the biggest sell-off in 5 years. Joining us now, Ira Jersey of Bloomberg Intelligence. You and I talk about this all the time, and we could debate for days on how much this is hedge funds, how much this is worries about future demand. But there are long-term issues, long fiscal issues that are on the horizon, and there are short-term ones, like that hedge fund leverage that Scott Bessent cited just this morning as being an issue. From where you sit, how does this set up the market moves in the days, weeks to come?
Yeah, so I think all of this is positioning, and it's positioning in different products. So what we have right now in the market, if you go back and you just look at what we, at the future positioning data that we received last Friday, it shows that asset managers are very long Treasury futures, hedge funds are very short Treasury futures. Because those hedge funds are very short Treasury futures, they need to hedge that by buying Treasuries outright. And then, so there's just if there's an unwind of just a little bit of that, you wind up seeing a massive amounts of volatility. Some of this is fundamental, but obviously the proximate cause is fear that foreign investors are not going to be buyers of Treasuries, and because of that, you've seen this pretty substantial sell-off. And it's not a huge surprise because all the financial regulations that we created to make all the banks and dealers safe and sound is hampering liquidity because they can't expand their balance sheet and intermediate the market. So everything that we're trying to do is just coming home to roost in this couple of day period right now.
Right, a good point there. A lot of this comes down to positioning, not just unwinding of the basis trade potentially, but unwinding of a lot of positions when it comes to asset managers as well. I want to talk a little bit about demand and sentiment and how much it depends on 1 p.m. today, because we had an auction of 3-year notes yesterday. It did not go over well. You had a big tail. Primary dealers who are obligated to bid in these auctions actually took the largest share since December 2023. Treasury sells $39 billion of 10-year notes today, Ira. How are you expecting it to go over?
Yeah, well, I think that since we've cheapened a little bit, I think one of the reasons you've seen some of the volatility recently is actually dealers making room because they knew that they did get a lot of 3-year notes, and now there's more risk out there, right? So 10-year notes have more or less 3 times the risk that 3-year notes do. So they're worried that maybe they'll have to take down some of this auction, and more importantly, tomorrow's 30-year auction, right? I think that's so between the 2 days, you're talking about a lot of market risk that's coming in, coming into the market. So dealers are making room, and that's another reason to think that they're only going to be buyers and intermediate this market at cheaper levels. So that means that you have higher yields, lower prices, and dealers kind of make room and pick where they're going to be selective buyers here, as opposed to just taking down every single trade from their clients.
Ira, I sit next to Shanali here at work, and as a result, I never hear the end of the basis trade, but I still can't quite wrap my head around it.
Let me do this quickly for you. So basically you have treasuries being bought on the short end by hedge funds, which is why it matters for the auctions. They sell the futures and they arbitrage the difference, but they do it to the tune of 50 to 100 turns of leverage. Highly levered trade. Now, Ira, we have seen the Fed come in with backstops before when this has caused issues in short-term funding markets. What would it take for the Fed to step in, not via rate cuts, but via some sort of backstop if these markets were to get much more interrupted, let's say?
Well, I think we're pretty close to that point where the Federal Reserve is going to have to think about doing what it does best, right, and its primary function as lender of last resort. And I'm not saying that they should go out and buy treasuries, but they created this thing called the standing repo facility. But the problem is it doesn't work as intended. Its design has flaws that don't make it the funding backstop for the treasury market and the mortgage market that people thought that it would be. So they really need to just do regular, everyday, temporary open market operations, repo operations, similar to what they did prior to 2008, where they were in the market every day, either doing repos or reverse repos, to basically meet reserve requirements and demands. And I think we're at that point. The other thing that this shows you, and I think that the market volatility highlights, is that we're very close to that lowest comfortable level of reserves, and that the Fed at some point in the near future is probably going to end its runoff program. It'll probably still run off mortgages, but ultimately they'll stop QT very soon.
All right, Ira, great to have you on the program. Thanks so much for joining us. Ira Jersey there of Bloomberg Intelligence. Coming up in the next hour, Cole Smead joins us, as well as the CEO of Air France and the CEO of Macmillan Publishers. This is Open Interest.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And, in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. U.S. stocks about 1% up or less hours after President Trump's new trade tariffs went into effect. Both China and the EU retaliated, and J.P. Morgan Chase CEO Jamie Dimon weighed in on Fox Business.
Do you personally expect a recession?
I am going to defer to my economists at this point, but I think probably that's a likely outcome.
China, which was hit with 104% American tariffs, is retaliating with 84% levies on U.S. goods. The U.S. has approved new tariffs, too. Food industry spokesman Andrew Harrig says customers could expect to see increases in food prices first.
Fresh products, because you can't build up inventories and there's a limited lifespan, you will feel that quickly, maybe as soon as a week or 10 days.
President Trump's just posted to Truth Social, be cool. This is a great time to buy. Still no definitive word on cause after at least 113 people were killed when a roof collapsed at a nightclub in the Dominican Republic. Correspondent Christian Benavides is in Santo Domingo.
Rescuers have spent hours searching through the rubble of the one-story building, desperately trying to get to any survivors. Among those who died was beloved Dominican merengue singer Ruby Perez, who was performing on stage when the roof collapsed.
Former Major League Baseball's Octavio Dotel and Tony Blanco were also killed. Police in Virginia say all suspects are in custody after 3 people were shot to death in a shooting at a townhouse complex just outside Fredericksburg. They say there is no threat to public safety. Pushback after a student conflicted over doing the right thing was suspended for the choice he made. CBS's Jim Crisula.
A judge in Virginia Beach, Virginia, said it was, quote, appalling that a school suspended a 6th grade student for waiting to report that another student had brought a bullet to class. The judge ruled in favor of the child's mother after she sued St. John the Apostle Catholic School for breaching its contract with her when administrators suspended her son for a day and a half last September.
Among this year's additions to the Library of Congress National Recording Registry. Debut albums from Chicago and Tracy Chapman. A Roy Rogers and Dale Evans song is on the list, too. Happy days to you. And the oldest entry among them. The Hawaiian Quintet's recording from 1913. Dow is up 191. This is CBS News. A new security report shows New Orleans needs to do more to make partying safe. WWL Radio's Dave Cohen.
This 44-page report by Teneo Risk finds that New Orleans remains vulnerable to terror attacks, particularly vehicle versus pedestrian attacks, like the one that killed 14 and wounded dozens more on New Year's Day. The analysis obtained by CBS News affiliate WWL-TV in New Orleans outlines the need for more robust intelligence, more efficient defenses, and better communication between agencies that it says was lacking even during the recent Super Bowl and Mardi Gras.
Prince Harry returned to court in London today for the second day of his legal fight over police protection. He's appealing the British government's decision to strip him of security after he and his wife Meghan Markle stepped back from royal duties and moved to the U.S. His lawyers argue Harry has been singled out. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York
Friday.
City. What? Did I say Friday?
You did. You just whipped ahead 48 hours.
We're not even close. Not even close.
It's not even Thursday.
Oh my! That
a
is
long
just
3
the
hours.
week it's been. That's the week, and we were commercial free for 3 hours.
No,
this
I
morning,
get it.
so now
I get
feels
it.
like
This
Friday.
week has been
All right, let's go
intense.
Wednesday here, folks. I like Wednesday. It's a nice day. A lot of stuff coming up here. We're going to stay on top of these markets. They've been moving big time just in the pre-market to where we are today. Big swings in the market, so we'll stay on top of that. We're going to talk to Christina Hooper. She's the Chief Global Market Strategist at Invesco. Dan Ives, Global Head of Technology at Wedbush Securities, he's going to be in studio. He has been in the news a lot lately on Tesla and some of these tech companies. The tariffs are crushing the technology industry, as you would expect, as it is many other industries. So Dan will have his updated thoughts there. So he'll be in our studio. That's always fun. Let's kick things off right now on this Wednesday with Mr. John Tucker on a Bloomberg Business Flash. John.
And this Bloomberg Business Flash being brought to you by IBKR. Will the U.S. Consumer Sentiment Index exceed 70 in April 2025 at IBKR Forecast Trader? The yes was recently at 29%. Start predicting today at ibkr.com/forecast. The last trading day for this contract, May 13th. It looks like investors scooping up some beaten-up tech shares. You have 7 of the 11 major industry groups in the S&P 500 higher right now, and it is information technology that's in the lead. NVIDIA shares, they are up 3.5% right now. Tesla shares up 4% higher. Apple shares, they are up 2.6% right now. The Bloomberg Mag 7 index up 1.8%. Now, overall, the S&P 500 19 points higher. That's up 0.4%. Right at 5,000 even. Dow Jones Industrial Average up 37 points. The Nasdaq 100 up 183 points. That is a rise of 1%. And of course, China fired back this morning. indicating no end to the trade war, announcing new tariffs of 84% on U.S. goods. Walmart reiterated its sales guidance today, expecting net sales to grow 3 to 4% this year, despite the tariffs. And in the early going, Walmart shares up 4.4%. And also, after its earnings report, although the forecast wasn't so hot, shares of Delta right now, best performing shares in the S&P 500, they are up right now 7%. And a change to the bond market, we saw a big sell-off earlier. Let me go to the 30-year, the long bond. But right now it is down 1 1/32, pushing the yield up to 482. So still some stress levels there. And as we check currencies right now, the dollar DXY, that was lower. Brent crude, Alex, down close to 4%. NYMEX crude down 235, 57.23. Brent right at 60.42. And we check the markets for you all day long, here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Hi.
Hi. Yeah, that was pretty brutal, that oil slide.
Yeah, it's only Wednesday.
Good. It's only Wednesday.
But
it feels like it's been like a year of trading
Exactly.
in the last couple of days. And, okay, stocks are higher, but remember yesterday? We had a 3.5% rally. Oh, man, that last hour, the close was really horrible in terms of technicals.
And of course, I lay the blame at Tim Stenovic and Carol Massar.
As you should,
Yes,
as you should, as you should. This is all completely fair and totally legitimate. All right, Alex Steele, plus me, John Tucker, Bloomberg Intelligence Radio. Let's take a look at some of the stocks on the move today. We're joined now by Bloomberg's Denitsa Sakova. Let's go to Delta because that stock is up. And I'm trying to read between the tea leaves here. Like the forecast, there was no forecast, but earnings were better than expected.
Yeah, it's a very interesting combination. Initially, when I saw the earnings report, they weren't about broad economic uncertainty. I thought that investors are very sensitive towards that, but we're actually here. It rose as much as 8.6%. It's up about 7% now. So incredible rally here. I think an important part of this market and what we're seeing in terms of dip buying is all those names who suffered the most, and Delta was down about 40% before this, are getting a big boost. Of course, the earnings report, we had a really good earnings report from them despite the uncertainty. Analysts are warning that despite all of this, investors should be encouraged by their diverse revenue streams, by their cost management. So when you look at the buy recommendation, there is definitely a lot of optimism among analysts. And then, of course, we got the first quarter earning that beat analyst estimates, so that's bringing some optimism. But Delta declined to reaffirm the forecast it issued in January. There is clearly so much uncertainty, but investors are buying the dip. So probably that uncertainty is fine for the first few hours of trading.
I mean, it just shows that how much was already priced into your point. It's on 48% since the peak in February, which means that for earnings season, if you beat, even if you pull guidance, are we going to re-rate just because we've already been so pummeled? BI maybe doesn't agree, but nonetheless. Peabody Energy.
Yeah, we have two different types of news bringing the stock higher. It was high as much as 21% in pre-market. Now, obviously, some of those gains have faded, but still incredibly strong day. We have a combination of President Donald Trump signing an executive order to expand mining use of coal in the U.S. And we also have a deal worth up to about $4 billion to buy Anglo-American steelmaking coal. So the combination of the deal and the combination of obviously what's coming out of the White House is really boosting the companies. We have a lot of measures, obviously, to promote electricity made from coal. So that's clearly boosting the company. And it's one of the biggest winners today. We're yet to see if that holds, because obviously everything's volatile. But that's definitely one name we're looking at.
Alex, what did you make of the president's executive order yesterday promoting against the use of coal, the mining of coal? Is this for domestic consumption? Is this for export? Both?
Well, it seemed to say that it was for AI demand in order to meet that. That's why it was sort of energy security. But at the end of the day, guys, it's economics. If it economically makes sense to build a coal plant, they will build it. If it makes economic sense to keep it running, they will keep it running. Now, coal is below natural gas in prices, so from that perspective, sure. But on a longer-term basis, I mean, TBD, would you really change what you're investing in terms of natural gas to coal? I don't know.
For the fireplace, I once bought a bag of coal from a guy in Pennsylvania. just to see. To experiment.
How did it burn?
Oh, it burns forever, hot as all get out.
Did it smell
but,
bad?
Man, what was coming out of the chimney? You don't want to breathe that stuff.
Right.
Just
there we
saying.
go. Just saying.
my observation.
You need carbon capture for his house. All right, and wrapping it up here, let's go to CalMaine. This is a. What is this a food company now?
Going to one of my favorite topics. It's an egg producer that reported third quarter earnings that missed consensus. But most importantly, we're hearing about investigations from the Department of Justice for the causes behind the increase in egg prices. Also, one thing I really like about this company, the ticker is COM. which is something we all need today. But the shares dropped earlier on Wednesday. There was a really big drop. Obviously, now things are so volatile on micro level that a lot of that drop was erased. But for sure, that's a very interesting name to look at, going to that egg price debate that has shaken the economy. But the company also said Tuesday it is acquiring Echo Lake Foods, a Vermont-based maker of ready-to-eat egg products. So clearly the egg economy is expanding. So that's an interesting name to watch. That's actually scoring small losses today compared to what we saw in pre-market trading.
All right, thanks so much. We really appreciate Denisa Sakova joining us. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Let's get the latest here on the economic conditions. Enda Curran is Bloomberg Global Economy reporter. On the latest with tariffs, I don't know, that's such a broad topic at this point. The latest is that the EU is going to be slapping tariffs on some goods into the European Union. How do you expect this to unfold in the next 24 hours?
Well, we've had so much news this morning. As you mentioned, Alex, China has retaliated 84% now on U.S. goods there. The EU have retaliated in kind to all its U.S. tariffs. So, without getting into the specifics of that, what it means is that all goods coming out of China into the US will now be more expensive. That's everything from everyday goods that we buy, like maybe blankets and umbrellas, right up to iPhones and electronics. Similar story with the European retaliation. What it suggests is that the economic hit is prices, as I mentioned, but secondly, there's no hint of an off-ramp just yet, no sign of an immediate round of negotiations. Now, we had a lot of commentary this morning from Treasury Secretary Scott Bessent making the point they are willing to talk. Lots of governments are coming here to talk to the administration, so that's clearly on the table. He also made it clear, though, that China isn't yet coming to the table for talks, but even in line for the negotiations that are ongoing, it doesn't feel right here, right now, like there's any kind of a near-term solution to get us back to where things were on the trade front before April 2nd.
So, and is there a sense here, was this retaliation by China, this 84, A, was it expected that China would retaliate, and B, was the 84% number higher or lower, kind of in line with expectations?
Probably expected that they would retaliate. That's been the language from them. Remember, the Chinese Commerce Ministry said this week they would fight to the end. They came back with this 84% level. On the one hand, that's a wild tariff level, obviously, just like the US one. On the other hand, you've got people saying, well, they didn't go to 104, didn't fully match the US, so maybe they're leaving some daylight room there for negotiation. But either way, we're clearly now in pretty much uncharted territory in terms of modern trade between the world's big two economies. Lots of analysts out there warning about how this is unsustainable. Obviously, it will lead to a slowdown in trade between both, and obviously it will drive up prices and slow growth for both. Prices more for the US and slow down China's economy. So, I mean, moving feast, there's a lot to get people to get their head around in this one.
A big tool here was a potential devaluation of the yuan. I mean, looking at that chart yesterday, when you had dollar yuan on an offshore basis on the highest level on record, it was unbelievable. How low can the yuan go without causing major disruptions?
Well, that's right, Alex. It's a tricky one because they don't want a disorderly weakening either, as we wrote out of our colleagues in Hong Kong and Beijing this morning. On the one hand, they are letting the yuan to weaken. The idea there being that will help their exporters, give them a little bit of a cushion. But, you can turn around and say, if you let it weaken too far, people want to get their money out of China. It won't make it an attractive place to invest, so you got the risk of capital flight. That's one side of it. You also have to think about diminishing returns. You can weaken your currency, but if the demand isn't there, and people are warning about slowing trade, if the U.S. consumer doesn't want to buy as much, if demand isn't there, cheaper currency won't do that much for your manufacturing base. Anyway, so to be expected that they would do this, they're trying to keep it orderly. To your point, it's a big question about how far they think they can push it.
All right, and we really appreciate, thank you so very much, Enda Curran, Bloomberg, a global economy reporter, a very busy man right now, joining us. All right, coming up, Eric Edelberg is Bloomberg Intelligence Chief Mortgage-Backed Security Strategist. Remember when mortgage rates dropped for a second?
Yes.
Yeah.
What happened?
I don't know. That's not going to work out very well. I'm Christina Huber, is Chief Global Market Strategist over at Invesco. She's one of the perfect people to talk to about the move that we've seen in the Treasury market. What is actually going on? And I'm really curious about the 10-year auction today, Paul. Will it fail?
I know.
He cares
I'm
now.
paying
He
attention
cares now. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. And buyers actually have shown up this morning. Tech shares, they are getting a lift right now with the NASDAQ 100. That is up 1.2%, up 198 points right now. You have NVIDIA among the most active. It's up 3.6%. Tesla shares up 4.2%. Apple shares 3.1% higher. Just parenthetically, Apple was replaced by Microsoft in terms of the members of the S&P 500 with the greatest weighting. So Microsoft back to number 1. The trade war intensifying, of course. President Trump's sweeping tariffs taking effect, including 104% China levy. This morning, China responded with an 84% tariff on U.S. goods. Also, this morning, the European Union announced it was adopting tariffs on $23 billion of U.S. goods. Shares of drug makers under pressure, with the president promising to announce major tariffs on pharmaceuticals, in his words, very soon. Pfizer share, New York-based Pfizer, down 3% right now. Treasuries plunged Wednesday. That would be today. Paul.
I'm all in.
Just to clarify.
Yeah, just to clarify, it's the middle of the week. Anyway, the benchmark 10-year yield rose to its highest level since February. Let me give you a Treasury quote right now. PX1 is the function on the Bloomberg. I'll do the long bond, down 29.30 seconds in price, so that's pushing the yield up 482. So I'll call that some stabilization there. Mickey's on sale. Disney announcing half-price tickets for kids 3 to 9 this summer. This is actually a first for Disney.
Yeah, never.
Hotel guests are going to get free tickets to one of the company's 2 water parks in Orlando on the first day of their stay. Guests who book rooms for 4 days or more in certain ticket packages will also be able to eat for free at the park and hotel rest. It sounds like an ad here, but they're facing a lot of competition from Universal.
So instead of $8,000, it will now cost me $7,000. Is that what it is? Okay,
but
that's
they
huge.
never do this.
Well,
never.
Yeah, first ever.
So this is competition from this expanded Universal thing. I think they're like doubling the size of the Universal thing. Comcast is, and opening in March, in the midst of all this economic uncertainty. So a little bit of an issue there. So anywho, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast now. I mean, I'm looking at the mortgage market. You look at the 10-year Treasury, that's kind of proxy for kind of the mortgage market, I think. Boy, we were back at 5% just in January. Then the rates came down pretty substantially, got down to 4.4%. I started doing the refinance calculations. Boom, we're right back to 4.8%. So I missed my 3-second window there. Erica Edelberg, she does this stuff for a living. Chief mortgage-backed securities strategist for Bloomberg Intelligence. She joins us live here in our Bloomberg Interactive Broker Studio. Erica, volatility everywhere, including the mortgage market, right?
Yes, lots of volatility in both your homeowner rates and especially in mortgage-backed security performance, which is really very, very dependent on what happens with volatility, because the option for people to refinance their loan or not is in play, especially right now with a lot of people having taken out mortgages at slightly higher rates from now. And we saw that responsiveness in this morning's MBA index, which is already very much in the rearview mirror.
Yep.
But, we had a surge of about, I think 56% in the VA loan refi index, the highest in September of last year.
Really? Okay.
But that will, that will probably reverse very soon.
So when you have this kind of volatility in the Treasury market and the equity market, et cetera, and cross-asset volatility, FX market too, what happens to volatility in mortgage-backed securities?
Mortgage-backed securities become equally volatile from a rate perspective, from a price perspective, but they get a double whammy. Because again, the whole thing about mortgage-backed securities is the timing of your cash flows is uncertain. You know that your credit is probably fine, pending GSE securitization, privatization issues, but you just don't know when you're getting your cash flows. If people are going to return it to you right away through a refi, if they're going to say, oh, geez, rates rose now and I'm going to sit on my home forever, like Alex. So we don't know if we have a Paul Sweeney environment or an Alex.
Yep.
No one's ever going to get an Alex Steele environment.
That is
Paul Sweeney's chomping at the bit to refi, and Alex is never going to move.
Never.
Yeah, exactly.
Never.
The two extremes.
Red headline crossing the Bloomberg terminal. U.S. weighs farmer bailout as China retaliation threatens exports. More reporting on that.
I mean, that's exactly what we saw in the first Trump administration because of the tariff.
I wonder if I'm a farmer, would I rather grow my crop and get paid or take a check from the government?
I think you want to grow your crop and get paid.
I don't know. I'll have to ask. I will ask Mike McClellan because he was a farmer.
Okay.
Okay, we'll do that.
I'll shoot him an email.
Yeah, we'll do that. Erica, credit quality in your market, how's it looking? Are people paying back their mortgages? Do we have defaults kind of coming up? Where are we?
We have very small upcreep in defaults. One of the things I've been looking at is things like debt, debt relative to your disposable income, et cetera. And because of that environment where rates were so low, and because so much people's debt actually still is their low coupon mortgages, It's actually relatively low, but in the riskier sectors like Ginnie Mae's relatively new issue, you know, which is kind of akin to what's going on with subprime autos, you are seeing defaults and delinquencies creep up. Mortgage-backed securities, agency mortgage-backed securities, their credit is still 100% secure for right now. So again, that just affects the timing of the cash flows.
All right, so the takeaway is I am not refinancing the mortgage on the Jersey Shore compound. Erica, thank you so much for joining us. Erica Edelberg, Chief Mortgage-Backed Security Strategist for Bloomberg Intelligence, joining us in studio. How about that? Christina Hooper, Chief Global Market Strategist at Invesco. We usually do the Zoom thing, but we've got her in our studio here in New York. That's great. Christina, you've got perspective. You've been around. This isn't your first rodeo. What do you make of the last 3, 4, 5, 6 trading days?
Well, you know, this is an environment in which there is just a super high level of uncertainty, and that is causing all kinds of wild swings in all different corners of the market. And I think this is not that dissimilar to what we saw in the early days of COVID. You know, that was a time when there was just an incredible amount of uncertainty, and markets reacted with an enormous amount of fear, wild swings, and you know, the other similarity is that it's all about policy. That the outcome of this crisis will be dictated by policy, and so in some ways that's helpful because you can do a scenario map and ask yourself, you know, if X happens, we think Y will happen. But it is a very, very unusual environment, just punctuated by just an incredibly high level of uncertainty.
Speaking of that, Amazon canceling orders that affect multiple products and vendors after China tariffs. They're citing trade disputes as risk factor, and this coming out in the annual report. The difference in obviously is that this is a self-inflicted policy. This is not what happened in COVID and we shut down and then we had to help. To go specifically to the Treasury market, are you seeing, are you hearing, are you worried about the Treasury market not functioning properly like we saw back in 2020?
So I certainly think that's a concern. Right now, I don't think we're seeing that, but we do know that our trading partners know some of our big vulnerabilities, right? And one of them is that we spend an awful lot servicing our debt. And so one way to punish us would be to sell U.S. Treasuries. So I certainly think we are aware of the vulnerabilities and we should be following it closely.
At Invesco, what is your, economic forecast? Do you have a recession in your forecast?
My base case is that if we see tariffs remain at these relatively high levels, we're more than 50% probability of going into a recession this year. Doesn't mean that it's going to be a deep recession, but I think that certainly the odds are in favor of recession if we see tariffs remain at relatively high levels. But if we were to see a de-escalation, we could easily see a risk-on environment with U.S. assets benefiting. So it is very much in the hands of policymakers.
And then to that point, you just look at Delta, right? Pulling guidance. If a company pulls guidance, you would assume the stock would sell off, and that would be really bad news, and the stock is up. It's sort of like it's not going to take much to maybe move the needle. Where is safety, though, now, as you wait?
So safety clearly is in gold, and that's many investors are articulating through their purchases. But there is also safety, of course, in Japanese yen, in the Swiss franc, some of the traditional safe haven asset classes ex-U.S. I don't know if there's as much safety in treasuries or the USD.
Wow, that's a statement. International, rest of world stock markets been outperforming the U.S. pretty well, and that doesn't happen very often. Is that a trade? Is that a longer-term trend, do you think? Are international markets maybe more attractive from an equity perspective?
Well, certainly from a valuation perspective, and for some markets from a dividend yield perspective, they are more attractive. And you have to recognize a very significant catalyst, which is the potential for fiscal stimulus, material fiscal stimulus coming from Europe and from China. And I think that can be a countervailing force to the headwinds that come from these tariff wars.
Countervailing force, could that also come in the U.S. in the form of tax cuts? Would that be enough?
That's a good question. I'd have to see exactly what those tax cuts look like, because keep in mind that it's lower income households that are going to be hit the hardest by these tariff wars. Of course, all consumers will be hit to the extent that the wealth effect is impacted, but I think lower income households, the burden is higher for tariffs. So what will the tax cuts look like, and will it benefit lower income households? So when I know that, then I can answer that question.
Another headline, China issues warning for students studying in the U.S. So there you go. Ripple effect, I guess you call it.
Yeah.
Fixed income, what's the play here, Christina, in fixed income for you guys?
So I think there's certainly potential in a number of areas. Again, a lot of it has to do with one's time horizon. But certainly floating rate, I don't see the Fed cutting rates anytime soon. I know 4 cuts are priced in. It's hard to believe that's going to happen in this environment where we're seeing market-based inflation expectations go up and where we're seeing consumer-based inflation expectations go up.
Aside from, I guess, from where you sit, what would certainty look like? Because to some extent, we know what stuff is. Like, we know what tariffs are. We know that. We don't know necessarily what all the response will be. So what would it take for you, as someone who's been in the market for a long time, to feel confident?
So I hearken back to the first Trump administration.
Hearken, definitely hearken.
And how that played out. 2018 was a really difficult year. The S&P 500 was down. We saw some foreign markets down much more. But just a modest alleviation in tariffs helped and gave markets confidence. So something like that, I think, is enough in this environment. There's really a bias towards optimism, especially in the equity market. So there's hope. You know, even if we were to get some kind of reduction, some deals negotiated with some countries, I think that could be helpful. That doesn't give us the extreme certainty that I think we crave, but it's enough.
Christina, thank you so much. We really appreciate it. Christina Hoover, Chief Global Market Strategist for Invesco, joining us live here in our Bloomberg Interactive Broker Studio, which is a good thing. Coming up, Dan Ives, Global Head of Technology at Wedbush Securities, on his outlook for tech companies post-Trump tariffs. I'm guessing the tune has changed a little bit. S&P up 45 points. That's 0.9%. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Maybe some bottom fishing. The S&P 500 right now up 20 points, a rise of 0.4%. Right now at 5,001 on the index. The Dow Jones Industrial Average 8 points higher. The NASDAQ 100, the tech-heavy NASDAQ 100, up 190 points right now. That is a rise of 1.1%. And among the most actively traded shares in the cash session right now, let's get right to it. At the top of the list in the S&P 500, you have shares of NVIDIA up 3.7%. Tesla shares up 4.7%. Intel, that's up 3.1%. Apple is right now up 3.25%. The trade war intensifying, President Trump's sweeping tariffs, they have taken effect, including the 104% China levy. This morning, China responded with the 84% tariff on U.S. goods. Also, the European Union adopted tariffs on about $23 billion of U.S. goods. The administration considering plans to offer assistance to farmers amid concerns about the trade war's impact on American agricultural producers. Let me find a farm stock. How about ADM, Archer Daniels Midland? That's up right now about 0.6%.
Deere
Amazon.
Deere is always my go-to for the
Deere, you can check Deere too. Okay. I like, what is ADM's supermarket to the world? Their commercial. Amazon canceling orders for multiple products made in China and other Asian countries. So the company reducing its exposure, at least that's the suggestion there, to the tariffs. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Happy Wednesday.
Happy Wednesday. JT, Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. To add on to that, the Delta call is underway right now, saying they see a significant drop in U.S.-Canada bookings, to some extent no surprise. And Delta has told Airbus that it's not going to pay tariffs on new aircraft. So who pays how, where, when, also quite interesting as well. Back to the news on Amazon. So apparently the things that they're not going to buy now, beach chairs, scooters, air conditioners,
all the
and
things
some
we
other
need
products, right, as we head into summer, have been canceled from China and other Asian countries. Joining us here in the studio, Dan Ives, Global Head of Technology at Wedbush Securities. Okay, so if we take a look at the Mag 7, all of them are up today. Which stock do you think has the best option for a meaningful bounce?
I mean, look, let's just take a step back. As someone 25 years covering tech, I mean, I believe this is the scariest time that I've seen the markets, but specifically for U.S. tech, because it's really it's really an Armageddon that's come from a supply chain perspective, and that's why we've been so vocal. And I think it's been almost sad to see, because I think as these continue, these tariffs, it would set the U.S. tech industry back a decade.
So, I mean, some of the tech spending is almost maintenance spending. But a lot of it is incremental and new stuff in AI investment. People were taking up their CapEx numbers huge. And what's happening? Is that just on the sidelines, paused?
Look, and Paul, me and you have talked about this for years, right? And it's a fourth industrial revolution. But the reality is that now CapEx, new projects, halted, getting cut across the board. And that's why you can't put the genie back in the bottle. Essentially, what you've started here is a huge sort of CapEx decline that you're going to have to see number cuts across the board. And look, for these tech companies, I've talked to so many executives over the last week. You can call Paul Sweeney, Dan Ives factory in the Midwest. Hey, let's get those semi-chips from there. They don't exist.
Right.
That's part of the problem.
But pause and terminate are two different things. So I feel like a week ago, everyone was on the pause button. Are you saying now we're in the termination phase of projects?
I think we've gone from pause to something that's 3 to 6 month delays. And ultimately, companies, they don't know what's happening in terms of their businesses. So it's like if they were going to spend $100,000 in incremental cybersecurity, maybe now you put that on pause, $50,000. You don't know what your CapEx budget is. So going back to like Alex, what you were talking about before in terms of the Boeing, like who pays it? Now it's it's like a Jenga puzzle. And that's always been the frustration here, is that what's happening, even when you get deals, the damage is being done in real time, and that's what the stocks are telling you.
What do you expect to hear from tech company executives this earnings season?
I mean, we just had silence for like the last 3 seconds, kind of that when it comes to guidance, because Paul, no one's going to give guidance. And the reality is that as we take stab at numbers cuts, right now, these tech stocks, like to your question, like NVIDIA, Apple, Microsoft, you're baking in 10 to 12% cuts into stocks today. So forget where Street is. Street, those numbers are 10, 12%. The reason we haven't downgraded any stock and we're still bullish on NVIDIA, on Microsoft, on it, because my view is like you start to get another 5, 10% cuts to these stock prices, you start to bake in a 20% cut. And I think that's where you start to get, you're seeing some of the bounces now because of that relative. Street's already ahead of where ultimately the numbers are going to be.
Which of the Mag 7 is last on your list for any kind of hope at this point?
Look, I would say, I'd almost like rephrase it in the fact that what's the one that's most massively, sustainably impact? It's Apple, and which is obviously one of our favorite names, because 93% of iPhones are built and made in China. Any concept that's all a snap of the finger is going to happen in India, I mean, I'm playing the Masters this week, okay? Same chance. So the reality is, like, where do they go? Do they call 1-800-Navarro? Hey, what do we do? There's no alternative. And the problem is that what does that do to gross margins? That supply chain, and even when you look at Vietnam, that's why you are basically taking an American technology icon here, in terms of Apple, and you're cutting it at the knees. And that's essentially what these tariffs have done. And that's what we've talked about. It's an Armageddon-like move that needs to be stopped and negotiated. Otherwise, the damage becomes more permanent.
I saw a lot of tech execs at the inauguration. I've seen them kind of hopping on the Gulf Streams, making their way to Washington. They didn't get much payoff on that, did they?
No, because I think, they're
That's
there.
the oil guys.
Oh, yeah.
And they're there thinking, hey, 15% reciprocal tariffs, we could live with that. Then the chart, without living infamy, comes out, whatever, call it, trade deficit converting some odd Goodwill Hunting, MIT lab calculation, that's a tariff, and that's where it all changed. Because how do you start negotiating? And this is the problem on companies and what we're seeing. How do you start negotiating? If I came in here and said, my name's LeBron James, and I play in the NBA, you're like, what? How do you even start? And I think that's part of the frustration with those numbers.
So why do you still have a buy on all these companies?
Because my view that this is over the weeks, over the months. If I thought
but if it's Armageddon and they have to fundamentally change their whole business model.
If this was permanent in its current form, you'd downgrade every stock in terms of the view. My view is similar as how with 25 years, how we did in terms of financial crisis, 2008, 2009, COVID playbook, 2020, it's the same playbook. 2Q, 3Q, toss it out. I'd say for the next 3 quarters, you're basically going to toss out as an investor. They're almost washes. Investors not going to look at it. We view it as the chaos gets to some normalized baseline. You start to look at 26 numbers, and that ultimately is how you justify names. But the reason we don't downgrade is our view that this is something, whether it's weeks, months, transitory, I hate using the word, but in some way that this is going to be negotiated.
30 seconds left here. Does the U.S. risk losing its leading position in tech, the great Silicon Valley?
I mean, I think this could take tech back a decade.
Right. Yeah, you said it.
And because it's the reality, it's the food chain, the supply chain is in Asia. It would take 4 to 5 years to build a new factory, and the concept where we can make in America this. If you like $3,500 iPhones, we should make them in New Jersey.
I really don't want that.
And that would take 4 years.
Right. Dan, thank you so much for joining us. Really appreciate it. Dan Ives, Global Head of Technology Research at Wedbush Securities, joining us here in our Bloomberg Interactive Broker Studio. He's historically been one of the most bullish folks out there on technology, but hey, when the situation changes, you got to change. And technology Armageddon here is out in terms of here, and we're certainly seeing that in the stocks really year to date, but certainly over the last week. We'll have more coming up. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Wednesday. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through a lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. The news that broke just about half hour ago is that we may be looking at a farmer bailout to offset some of the issues and the chaos caused by a tariff war with Trump. So we want to ask, would a farmer rather sell their crop or would they rather get a bailout? So joining us, the perfect person to talk about this, Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist who also used to farm stuff. Hey, Mike, what do farmers want?
Well, Alex, one thing I appreciate about your questions is you know the answer to that one. Most of our viewers do, and that's being in the Bloomberg Farm Fuel Conference in Indiana, which was about 100 miles away from where I used to own a farm. It's clearly farmers just want to be able to sell at a decent price so they can make a profit. They hate subsidies. They hate that they have to depend on it. And now it looks like the only major thing other than some kind of bailout or like things that I even put my own land in conservation and reserve program is biofuels. If we can create a little more demand for biofuels and ethanol and mostly biofuels, then that would help because, we have to export about 45% of our wheat and soybeans and about 15% of our corn. So we have a glut.
So, I mean, how does a farmer going to see it here? I mean, are wholesalers not going to buy their crop because the wholesalers know they don't want to have to deal with the tariffs when they export it? How does that all work out?
Well, that's the key thing, Paul. It's already started. The key thing that has been bad for farmers was that what was good was the massive pump in prices because of Russia's invasion of Ukraine to the peak in 2022, somewhat like World War I. It was great for U.S. farmers for a little while, but now it's gone away. But what it did do is it ran into this firewall of rapidly advancing technology where Brazil now is going to be exporting about 110 million metric tons of soybeans. That's double what the U.S. Used to export. And China's taking them, but they don't need as much anymore because they're adopting genetically modified seeds. So the overall picture for farmers was bad before the tariffs came in. The thing is, this is the heartland. This is the land where people voted for Trump. It's, they're less concerned about the stock market. Yeah, so he's going to do what like last time he wrote him checks. Now that helped, obviously, but people just don't like that. It's like if you can find a way to get corn to stay above $5 a bushel, yeah, we'll do that. And by the way, we'll create a lot of it, and that's the problem. Then we'll make it go lower. It's just the trend is creating more with less. Unless we get a drought, prices are going to probably get pretty cheap.
Here's my insanely dumb question. Is there not enough demand to just sell all our stuff here in the U.S.?
No, there's not. One of the biggest places we export our ethanol is to Canada. Oh, that might not work out so well. We export 45% of our soybeans. It used to be 55%. That's going down. We've been dropping our wheat production for at least acreages for years because we don't use much of it. We export most of it. We're basically the piggy bank for the world. But corn, that's a unique market. We only export about 15% of it. A lot of it's used for motor fuel. And one thing I want to remind our listeners, before the introduction of internal combustion engines, a large portion of our land was used for transportation fuel for horses.
Exactly. So, Mike, I'm going to front run Alex on this question here. Oil below 60. I mean, now this is getting serious here. If I'm an oil man down in the oil patch in, West Texas here, what's going on?
Unfortunately, that's one thing they get is typically after prices get really high, it's the high price cures now have to transition to low price cure. So unfortunately, I had a good friend of mine from the oil patch text me on Tuesday when I pointed out $40 a barrel, which I've been pointing out for 2 years. Like, Mike, no, don't do that to us. I'm like, I'm sorry, but that looks like things will have to go. So the good news is we're right near the U.S. average cost of production, the largest producer of energy on the planet for crude oil. $56 a barrel. Bloomberg New Energy Finance said they'll probably do okay around 50, but typically you got to get around 40 or lower to shut it off for an enduring bottom. So we're heading towards that low price cure. It's happening globally. And remember what's happening since we pumped up in prices because of Russia's invasion of Ukraine. We're increasing supply, still decreasing demand, most notably from China. And unfortunately, prices have to go down to really shut off those excesses. It's just the way the cycle usually works. And so it needs some kind of shock for it not to happen.
And what we're not going to get is a step in from Saudi Arabia because OPEC Plus announced kind of the same moment we got tariffs from the Trump administration that we were looking at more oil coming on from OPEC Plus because in essence, this is the theory, is the Saudis want to ding the overproducers like Kazakhstan, Iran. They want to get that compliance back, which means they will tolerate lower prices, which gives everyone anxiety back of 2020 and 2014 at the end of the day, Mike.
Exactly. By the time we get to midterms, the average gallon of gasoline in this country, which is around $3, is more likely to go to $2. And what's the stated goals of our Trump administration? Lower inflation, they might get more deflation, lower energy prices, lower bond yields. It's all going that way. A little blip lately in bond yields, but and I think Saudi Arabia is a pretty good ally, and Trump seems to get along. So we all see the tilt there.
Which is so interesting because you know who this is good for? Well, consumers, but also like Delta.
Yeah.
Like you can see a lot of companies already locking in their hedging costs when they're like, ooh, lower prices, let me lock that in right now.
Yep. There's a lot of cross currents out there. Mike, 30 seconds here. What's the play here for you? What are you talking to clients about today?
Gold higher, Bitcoin lower, and virtually most commodities continue to go lower. Deflation from the inflation is a normal cycle, particularly when you have a paradigm shift of what's happening in the U.S., kind of shutting off the ability for the rest of the world to export to the U.S. and the almost unprecedented austerity. Unfortunately, the trends were in place before Trump was elected.
All right, Mike McGlone, thank you very much. Appreciate that. As always, Mike McGlone, he's a commodities dude. He's at his agricultural conference out there in Indianapolis, Indiana.
I want to go.
And I think they're talking like corn and soybeans and stuff like that.
Love this.
Mike knows this stuff. He lives this stuff. and commodity investors value his opinion in large part.
For our listeners in the U.S., reminder, go ahead and listen to us satellite radio, Sirius XM channel 121, world's only global audio business network, coast to coast, 24 hours a day. Go ahead, Sirius XM channel 121. That is presented by Oracle. Next hour, Bloomberg Intelligence is now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Wednesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a fast and furious moving market for you. We got a great lineup of guests as well. Ira Jersey of Bloomberg Intelligence will be joining us about the liquidity in the bond market. Is it normal to see a 55 basis point increase in 3 days for the third year? I mean, maybe not. We'll see how liquidity is faring. Leland Miller, also one of the best out there from China Beige Book, to talk more about the relationship of U.S. and China and the tools that China has to combat any tariffs. Burns McKinney over at NFJ Investment Group on the markets, and Geetha Ranganathan, a Bloomberg Intelligence analyst on U.S. media ad agencies, also getting hit. And George Ferguson will talk about Delta. But let's kick it all off for you with a Bloomberg Business Flash. And for that, we go to Charlie Pellet.
Hi, thank you very much. And here's what's going on. We've got another choppy session today. Right now, we are trading just about at the lows of the day with the S&P 500 index down now by 26 points. That is a drop now of 0.5%. The Dow Jones Industrial Average lower by 266 points for the Dow, a decline now of 0.7%. And West Texas Intermediate Crude Oil, it is slumping today. WTI below 56.25, as we were just talking with our Mike McClone, down now by 5.6%. The 10-year, 4.37%, with the 2-year, 3.75%. And gold, 3,067 on the precious metal. Gold surging 2.8%. Bitcoin down 0.1%, 76,975 on Bitcoin. As for markets and tariffs, Christina Hooper is Chief Global Market Strategist at Invesco, and she was a guest right here on Bloomberg Intelligence.
My base case is that if we see tariffs remain at these relatively high levels, we're more than 50% probability of going into a recession this year. Doesn't mean that it's going to be a deep recession, but I think that certainly the odds are in favor of recession if we see tariffs remain at relatively high levels. But if we were to see a de-escalation, we could easily see a risk-on environment with U.S. assets benefiting.
Christina Hooper of Invesco speaking last hour right here on Bloomberg Intelligence. Keeping an eye on Amazon shares today. Amazon has canceled orders from multiple products made in China and other Asian countries, according to a document reviewed by Bloomberg and sources suggesting the company is reducing its exposure to tariffs imposed by President Trump. Again, recapping U.S. stocks right now, we've got the Dow, the S&P, they are both in the red. NASDAQ is advancing, S&P down 30, choppy session down by just about 0.6%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We are live here in our Bloomberg Interactive Broker studio in Midtown Manhattan. We are streaming live on YouTube. So head over to youtube.com, search Bloomberg Podcast Live, and that's where you will find us. As Charlie was just reporting, the indexes are all over the place in the equity markets, but let's see where the action is under the hood. We do that with Isabel Lee, cross-asset reporter for Bloomberg News. She joins us here in our studio. Isabel, what are you looking at?
I'm looking at Eli Lilly. So shares are edging lower by almost 5%. So Trump has long promised that his tariffs on pharmaceutical drugs will be coming soon, and it is coming soon. This is the latest signal that he really plans to press ahead with those sectoral tariffs, despite this really huge market fallout. I believe it's more than $10 trillion in the past 4 days. So Trump believes the tariffs will encourage pharma giants to produce more in the U.S., and he's confident that they will come back because the U.S. is the biggest market. But again, the lack of information makes any assessment really difficult. That's according to Bloomberg Intelligence, and implementation could take time. And also, the generics, which are mostly made overseas, I mean, that may affect prices
Yep.
too. And if you're hard on money, you usually go to the generic. So
Yep.
Oh yeah, well I go to the generics anyway. I mean, $1 drug is better than 300 for sure. And medical devices too would get hit from that end as well. All right, let's go to Walmart here. So I was surprised that they reaffirmed their outlook despite all the uncertainty.
Exactly. So it was higher by around 5%. It pared back some of those gains, but still up by around 3.3%. So they did reiterate their guidance despite the barrage of tariffs and weakening consumer sentiment. And it really just highlights how the world's largest retailer basically is confident that it can navigate economic uncertainty. So Walmart said that it's seeing net sales growing 3 to 4% this year. So the forecast accounts for tariffs, unlike its previous outlook in February. And Walmart is really seen as a barometer for consumer sentiment. I mean, it's really due to its sheer size and exposure to a broad swath of U.S. consumers. And they said they plan to absorb potential price hikes, and they plan to keep their products affordable. We do have D.A. Davidson analysts saying that this could squeeze profit in the near term. But still, Walmart has actually performed historically better during economic downturns.
Yeah, okay, they can deal with it, but the mom and pop shop owner, I'm not sure. And
Yeah.
boy, they vote too. So again, the politics is lost on me. What else you got?
Ford. So Ford is edging lower, and now actually it's down by around 1%. We're seeing a lot more pressure there. We have Bernstein downgrading the stock to underperform from market perform with a price target of $7. Bernstein said that there's significant downside for the stock that's not priced in by the markets. I really feel like these automakers are just getting hit day by day. So the analyst, Daniel Rosca, says the tariffs impact Ford just as consumer sentiment wanes. So he says that this is really going to have more downside. But Ford still has 5 buys, 13 holds, and 8 sell ratings.
I mean, this is tough. This analyst at Bernstein, sell Ford stock because there's nowhere to hide from tariffs. Oof.
I mean, yeah. And there's still 5 buys, you said? I mean,
I think about it.
Maybe
We just
things
talked to Mike McGlone about the farmers. If Walmart's okay, that means probably the smaller retailers not. And auto industry. I mean, these are American key
iconic
constituencies.
Yes.
I don't get it. I don't get the politics. That's
He
my
doesn't get
thing.
the politics.
Yeah, I understand the economics. I just don't understand the politics.
You know what we get? We get the bond market. All right,
Yep.
Isabel, thanks a lot. Bloomberg's Isabel Lee joining us. For more conversations just like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market, and listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. So speaking of bonds, it is the most important auction we've ever had. This is what I'm hearing from analysts. Even Paul is pumped about it.
Yes, I got my
put that
alert
in
set up.
relative term.
Yep.
We get a 10-year auction today at 1 p.m. And the big question is, what will the direct bidders be, that domestic demand? What is the real demand for treasuries right now in the middle of this sell-off that we've seen? Ira Jersey is Bloomberg Intelligence chief U.S. interest rate strategist, and he joins us now. We finally got Paul into the auctions, Ira. How are you going to be receiving and looking at the auction today?
Yeah, so, well, we'll see where we are at 1 p.m. You know, earlier today, actually, when Paul and I talked just like an hour and a half ago or so, I was thinking, 10-year yields were up 14 basis points, 15 basis points today. It feels like dealers are trying to make room to absorb some of the supply coming out the next 2 days. And maybe they, even investors might dip in their toes, at cheaper levels. And now, of course, we've rallied now 7 or 8 basis points, so you've taken away some of that relative value. We'll see where we are at 1 o'clock, but like you said, the lack of direct bidders at yesterday's 3-year auction is really interesting because there's very little insight that we get into who those direct bidders were, whether they were banks or domestic investment managers, foreigners, like foreign central banks. We know some of them can bid directly for Treasury auctions. So we're making an assumption that it was foreign investors that didn't participate yesterday. I think that's a solid assumption, but it can't be all of it because foreign investors only took 8.5% of the auction, of the 3-year auction in March. So how is it possible that for the 3-year auction in April, when you saw direct bidders go from 25% to 6%, it can't only be foreign investors. It has to be domestic investors as well. And I think that I suspect that just people don't want to catch a falling knife. So today's auction could be, I don't want to say pivotal, but it certainly could be, is something to watch and pay attention to. And it always is, right, Alex? So, auctions are boring until they're not. That's why we pay attention all the time.
Ira, early in my career at Solomon Brothers, as a young banker, we would look at the government bond traders as just kind of larger than life. You step aside when they walk down the hallway here because they had such sway on the market, and we had so many of them, and they had such a big book of business, and they made a lot of money for Solomon. It's not like that today, and I'm wondering, you know, can the primary dealers today, can they really provide the needed liquidity?
So the simple answer is no, and I think that that's particularly true today because dealers right now are very full of treasuries. In fact, dealers own more treasuries than they ever have. Now the market's bigger, that's true, but you see the dealers, because they own so many treasuries, their ability to buy more of them when the market's selling off has been significantly reduced. And you've seen that in the market volatility, and I think that's really important. So will there be a policy response? One of the big questions I'm getting today is, when does the Fed step in and buy? Well, I don't think the Fed's going to step in and buy treasuries anytime soon, but they can do things like repurchase agreements and do their normal lending, lender of last resort activities, which they used to do prior to 2008 on a daily basis. So they can do traditional repos, what we call temporary open market operations. The government reducing and or taking treasuries out of the supplementary leverage ratio, one of these bank capital rules, I think would help quite a lot as well. They're already talking about it. They've been talking about it since Donald Trump took office. So, you know, maybe this will help accelerate that process and help create a little bit more market liquidity for treasuries, which, quite frankly, is in the best interest of the government to do.
All right, great stuff, Ira. We're looking forward to 1 o'clock. You know I'll be pinging you after that. Ira Jersey, Bloomberg Intelligence, U.S. Chief Interest Rate Strategist, joining us there. Let's take a broader look now at the relationship of U.S. and China. It's not good. What's the off-ramp at this point? Joining us now is Leland Miller. He is a CEO of the China Beige Book. Leland, you are deep into the China economy, China-U.S. trade relations, et cetera. What levers does China have to pull to help support its economy in the middle of a trade war?
Well, you know, markets have been expecting there to be some sort of giant stimulus response for years, and they were always disappointed because it wasn't in Xi Jinping's interest to sort of rejuice the economy after they've gone through maybe not deleveraging, but certainly a tightening of credit to areas of the economy outside of their priorities, like advanced manufacturing, et cetera. We're entering a very new era here. And so depending on how severe geopolitics and the trade wars get going forward, they're going to start looking at these levers more seriously. Obviously, one of the big ones is fiscal spending. They don't want to do a bazooka like 2008, and they've already done a lot of monetary easing over the course of the past couple of years, so there's not that much oomph there. But there is spending they can certainly do. And in our latest data, we have actually seen our proxy for infrastructure, infrastructure spending start expanding and go up. Transportation construction, firms are borrowing more, they're investing more, they're hiring more. So they are readying the ammo gun in case they need to use it. But I think they're trying to figure out whether this is going to be a short-term problem or whether this is the new norm.
So, Leland, nobody knows this better than you, but where is the capacity for China and the willingness for China to really go toe-to-toe with President Trump in the U.S. on these tariffs? What is their capacity there, do you think?
Well, their capacity and their willingness are two different things. I think their willingness is very high. I think we're already seeing there was a signaling before it happened, and then now that it's happened, you see there was the message was always, if you do something to us, we're gonna respond. You do something else to us, again, we're gonna respond. Now the problem here is that China doesn't have the capacity to go one-on-one in the trade field with the United States, simply because the United States is a massive importer and China is a very weak importer by comparison. So if you're just talking about trade, the U.S. has much more leverage and can put much more pain on China. This is why once you get to a certain point, and to the extent that Beijing is willing to risk an escalation, you're going to see things expand outside the purely trade realm. It's not going to be just a conversation about tariffs. Already, we're moving outside of it, but you could expand it more dramatically to other areas and even pushing U.S. firms on the ground in China.
I mean, yeah, we already heard the headline that China's, telling students that want to study in the U.S., like, think twice, for example, before you do that. In terms of levers it can pull, I know you mentioned helping domestic capacity and sort of pumping money into the system for consumers might not be the best. But in terms of the UN devaluation, for example, how orderly can China keep that?
I think they can keep it pretty orderly because they want to keep it orderly. You know, it seems like every time there's any kind of geopolitical tension between the U.S. and China, any trade tension, there's anything going on in terms of just a weak Chinese economy, there's people screaming to the sky, the yuan, devalue it, devalue it. They really don't want to do this. It's not that it's not a tool in the box to use, but it's for break the glass emergencies. It doesn't mean they're not going to blow off steam against the USD. It doesn't mean they're not going to have a signaling purpose from moving it incrementally. But they really don't want to do one of these one-off devaluations. It would be a massive escalation. It would be seen very poorly, not just the United States and around the world, but you're also sitting in a situation where you're going to create a lot of stress inside the Chinese economy. You're going to put pressure on having more capital outflows. You're trying to increase consumption. By weakening the yuan, you're going to hurt consumption even further. So this is not just some piece of trade artillery that they can use willy-nilly. To go there in a big way, they need to really have a substantial escalation.
Hey, Leland, does China view this U.S. nationalism from President Trump administration from a global trade, from a global military, political, as a real opportunity to expand its influence? Do they view this as a once-in-a-lifetime opportunity to do that?
I think there's a lot of voices in China. I think that they don't like some of what's happening. I think other things they see as an opportunity. Certainly, if U.S. allies and partner relationships are breaking down either in the region or around the world, they'd love to take advantage of that. And not necessarily by replacing the U.S., by simply saying, stop helping the U.S., stop buying into what they're doing. So there are opportunities in here if it's played wrong by the U.S. government. But I think that we're in such a dramatic place differently from where we were a few months ago. They're trying to digest this just like the rest of us.
Will this move China to make connections and trade deals and more economic ties with the rest of the world? Is the rest of the world open to that?
China would love lots of trade deals, but China wants them on their terms. And what they want to be able to do is not import on other countries' exports, and they want to just shove their exports down everybody else's throat. So to the extent that they can strong-arm countries or there's unique advantages to having some sort of bilateral relationship, then maybe these proceed. But keep in mind, to the extent the U.S. shuts itself off from Chinese goods, we import a lot of Chinese goods and have for a long, long time, then they're going to have to send these goods somewhere else. So in addition to all the overcapacity problems you already have, you have simply a need to replace the demand for Chinese exports elsewhere. They're going to be flooding Southeast Asia. They're going to be flooding Europe. They're going to be flooding South America. So this is going to have to demand a policy response from all these other countries. And the question is, do you really want to do a trade deal with the Chinese if you're not getting anything back in return?
Leland Miller, thank you so much. We appreciate your time as always. One of our go-to voices on all things China economy. Leland Miller, CEO at the China Beige Book. One of the things we like about chatting with Leland is at the Beige Book, they have really unique data. They have boots on the ground. They don't rely upon the government data because that historically has been not quite reliable. So again, they have their own data sets there that they rely upon to give them a sense of where the Chinese economy is. We find out from Leland that he's usually ahead of this stuff. So appreciate getting his time. Coming up, we're going to check in with Burns McKinney, Managing Director and Senior Portfolio Manager at NFJ Investment Group. Discuss the outlook for these markets. And Geeta Ranganathan, Bloomberg Intelligence, she's a media analyst there. What's going on with advertising out there? This can't be a good environment. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Day long at Bloomberg, another chaotic day for the U.S. stock market. The Dow, the S&P, NASDAQ, all back in the green right now. We've got the S&P 500 index moving higher by 27 points now, up by about 0.5%. Dow Industrials up 115. That is a gain of 0.3%. NASDAQ is advancing 1.3%. The NASDAQ 100 index up 1.2%. But the Russell 2000 index of small cap shares trading lower by 0.6%. 10-year 4.37% now, with a 2-year 3.75%. Spot gold up $100 the ounce now, $3,083, up 3.4% on spot gold, while West Texas Intermediate crude is now slumping by 4.6%, $56.84 for a barrel of WTI. Bitcoin up 4.10, 77,342 on Bitcoin. Walmart is reiterating its sales guidance despite President Trump's barrage of tariffs and weakening consumer sentiment, suggesting the world's largest retailer is in a good position to navigate a historic period of economic uncertainty. Walmart shares, they're surging now by 4.1%. So recapping, U.S. stocks are higher right now. President Trump urging Americans to remain calm and continue investing as his sweeping reciprocal tariffs hit in an indication the White House is closely monitoring market reaction to the levies. In a post to his social media site, Trump this morning in all caps saying, quote, "This is a great time to buy." Also encouraged his followers to, quote, "Be cool." I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York. We are streaming live on YouTube as well, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. As Charlie was just reporting, markets swing to green, to the red, up and down. Right now, we've got a little bit of green on the screen, but wait 5 minutes, I think. So how do you play this kind of market here? Let's check in with a professional, Burns McKinney, Managing Director and Senior Portfolio Manager at NFJ Investment Group, located down in Dallas, Texas. Burns, what have your conversations been with your clients over the last 4, 5, 6 days? What have they been like?
Yeah, it's really, I think everyone is on edge, and your last statement before I came on really calls to mind the the mindset people have about weather down here in Texas. So if you don't like the weather, wait a while, and if you don't like or if you do like the markets, wait a while. Really ever since I actually call it Obliteration Day last week. The markets have really, it's almost impossible to predict what's going on when really the key cog in it is just what's going on inside the mind of one person. So
Burns, where do you head out? Where do you hide out then in that perspective?
Really in this type of market, investors should certainly consider being somewhat defensive. One of the areas that we've been focused on are companies that are paying and have a track record for raising dividends. You think of your dividend aristocrats. That just basically means you're focused on the companies that are generating a lot of free cash flow to pay those. You're looking for the types of names that have clean balance sheets, and really those with stable, recurring, and predictable earnings. And obviously a lot of I think one of the key things that people are saying is that we'll look at companies that are more domestically focused that aren't necessarily exposed to the tariffs. But the problem is you have this kind of contagion, you just can't escape it just because they aren't exposed. For example, the banks aren't necessarily exposed, but their clients are. And so if this does tip us into a recession, there really aren't going to be a whole lot of places to hide.
So any sectors that historically perform less bad or better if we are, in fact, seeing a slowing economy going forward?
Certainly. Historically, I think two of what are considered the most defensive sectors by nature are consumer staples and utilities. Now, consumer staples have gone a long way towards pricing that in as investors have really flocked to those areas of stability. But utilities, they had a solid year last year, but the prior year they had their worst year in like 20 years. And right now, if you look at, within the S&P or within the indices, the weighting of utilities is at one of its lowest levels in years. And you have an area there where you have names that, a lot of their, price increases are regulated. They do pay healthy and hefty dividends. And, likewise, investors also have the benefit there, especially in some of the electric utilities, of the types of companies that might be sort of a side door and lower valuation way of taking advantage of that AI trade, simply because, a lot of these, data centers and cloud computing just simply require a lot more electricity. And so that's probably one of the first things that comes to mind.
Before I let you go, I wanted to just get your take on how you're going to be looking at earnings season. It was surprising to get Delta. They're pulling forecasts, yet the stock was up. Walmart did say they're sticking by their guidance of 3 to 4%. What kind of earnings are you going to be looking for, and what would constitute good at this point?
Well, this is going to be a very unique earnings season insofar as investors are probably going to need to completely look through what the current figures are. Current quarter earnings are probably, given the fact that, we entered this year in an economy with, you had GDP growth of 2%, inflation finally back down to around 3%, and unemployment around 4%. That's about as close to Goldilocks as you can get. And so a lot of those earnings that companies are going to be reporting, that's going to be yesterday's news. And what matters more than anything is going to be the guidance. And we do expect to see more companies either pulling their guidance like we saw from Delta this morning, or just simply, issuing a great deal of caution, I think is probably the best way of thinking about it. We look at the S&P today, investors might argue that valuations are more attractive now because the multiples pulled back, but the E in that multiple may soon have the floor kind of pulled out from beneath it.
All right, thanks so much, Burns. Good to see you. Burns McKinney, a managing director and senior portfolio manager at NFJ Investment Group, looking at the markets. All right, let's turn now to media. So, it's going to be a multifold issue here, right? On the one hand, you have the theme parks business are going to get hit, right? You already are looking at Disney kind of revamping their prices. Also, you have people maybe cutting their budgets, and then you have ad sales maybe also cutting their budgets. Geetha Ranganathan, Bloomberg Intelligence analyst on U.S. media, sits in all of it. How does tariff turmoil affect the media guys?
Yeah, that's a great question, Alex. So it's really, there's no direct impact as such, but as you pointed out, there is this second order kind of derivative impact. So yes, ad sales is definitely going to be at risk, especially as we kind of head into a recession. And then you do have, again, the demand risk, the second order demand risk when people kind of now face inflationary pressures and have to kind of shift their spending away from, discretionary spending into just spending on consumer staples, which are probably going to be much more costly. So yes, we are going to see some impact when it comes to, let's say, theme park visitation, when it comes to, let's say, the box office, spending on anything, discretionary in the entertainment sector.
Boy, I was just looking, Geetha, at the advertising agencies to get kind of a good framework to see where the expectations are for advertising. In a word, I guess, 2 words, not good. I'm looking at the stocks down, year to date, 20 to 30% for the Omnicoms, the Interpublics of the world, those types of companies. That tells you all you need to know, because that seems like people don't feel too good about the advertising outlook.
Yeah, the advertising outlook is really, really challenged right now, Paul. So, for the ad agencies, they were already kind of settling into a new normal. Remember, the ad agencies were already facing a tough environment, just kind of being disrupted by the Googles and the Metas and the Amazons of the world. But they were kind of settling in. They were still kind of finding their place. But, you have this whole new problem that they face with tariffs. And they do have diversification, both in terms of exposure to different verticals as well as exposure to different geographies. But I don't think that's going to be enough. So, we saw their organic revenue growth, which is the main measure for ad agencies, settling in around 3 to 4%. We think that's going to be well below, 2%, maybe 1.5% this year as we kind of price in all of this tariff fallout.
Does this might be a super dumb question,
no.
But when I'm like a Netflix and I'm an Apple TV and I'm those kind of streamers, like, do I cut back on budgets in this kind of scenario?
I don't think so. So I think, the streamers are relatively well positioned And especially within the streamers also, we think that there could be a little bit of divergence here. So if you look at someone like a Netflix in video streaming or a Spotify in audio streaming, we think they are the best positioned. They are the most insulated, just kind of given their market dominance. And the fact that they are the best go-to services out there. So switching costs are already pretty high. Nobody really is, canceling their subscription right now. So churn has always relatively been pretty low for these best-in-class services. And remember, Netflix also has, in case people are kind of feeling that pinch on their wallet, Netflix also has a $7.99 option if you don't want to be paying the $25 a month. So I think whichever way you go, they are pretty insulated. In some of the other, Alex, you brought up some of the other streaming services. Maybe, if you're paying for, let's say, 7 or 8 or 9, maybe you might cut a Peacock or an Apple TV. I don't know. But Netflix, Amazon Prime, HBO Max, I think these all will kind of stand the test of time.
Geetha, John Tucker was reporting a Disney story earlier this morning about how the Disney is offering in their theme parks in Orlando some deals to encourage families to come. Young kids can, eat free and things like that. I was telling John, I can't recall Disney theme parks offering deals very often here. Is this in response to Universal's new Epic Universe, which is going to open up in Orlando? Is that kind of what's happening here? Or is this reflecting just underlying weakness?
There is some underlying weakness, Paul, absolutely. But I think all of these recent promotions that we're seeing from Disney, especially in the Florida theme parks, is an absolute response to Epic Universe. That opens on May 22nd and will be a huge, huge challenger to the Disney parks. Remember, Disney gets about 100 million visitors a year all across the world. 50 to 60 million of those are in Florida.
Wow.
Universal, on the other hand, gets about 30 million or so, but we think that this could effectively take Universal's visitation just with this new Epic Universe up to almost 45 million. So very, very close to the Disney Florida park attendance. So they're going to be a huge contender, and I think Disney is kind of preparing for that.
Okay, so maybe it's not like an economy hit yet, but that could come on top of that at the end of the day?
Absolutely. So, and that could be something for all the parks in general, especially destination theme parks like a Disney versus, let's say, a Six Flags, which is more like a day trip. But if you're, again, comparing between Universal and Disney, especially in the Florida market, I think there'll be more of that wow factor right now to maybe check out a Universal park instead of Disney just because of all these new attractions.
I gotta say, I'm hearing a lot of people next week, public schools, vacation, they're going to Disney.
Yep.
So it's definitely not sort of out on nothing at that point. All right, Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media, just checking out on what all of that means when you add in tariffs and then the weaker economy.
Walt Disney stock is down 26% year to date, so it's, the market's definitely concerned.
Yep.
So there you go.
Market's definitely concerned, but then let's take a look at the broader market. And again, if you blink, you'll miss it. NASDAQ still up 0.8. We're definitely well off the highs of the session, but the S&P is still in positive territory, Paul. But, what happened yesterday was tremendous, right? We had that huge rally, and then all of a sudden we broke below into a bear market on a closing level for like 3 seconds, and then we rebounded off of that level. But it was a brutal move.
I tell you, this market, we saw it today. It is just one tweet away from a 2, 3, 4% move in either direction, and it likely is to stay that way until we get a little bit more clarity here.
Yeah, so and also when you have a VIX at 50,
yes,
around that, like, how does that resolve? Like, have we seen that without some major intervention from some way or another? Very long. Anyway, bond market selling off in the long end too. This is Bloomberg.